I'm here outside of Wall Street to bring you the education that's been locked inside those walls for decades. Generations of knowledge that was almost lost will be brought to light. Welcome to the Wall Street Collective, brought to you by the Daily Traders. Let's pick up where Wall Street left off.
Hi, everybody. My name is Chris Cady. I've been teaching trading now for 2 or 3 years, but I've been a member of the exchanges here in the United States, both the equity and the futures exchanges, for over 4 decades. I got my first day on the floor when I was 19. I got my membership when I was 20. And so I know what it's like to start out on the bottom rung and have survived many years. And so I'm excited to help everybody from the beginning levels, literally from the very beginning. And what I did remember from my first day was that there is no such thing as a dumb question. And the only caveat was that you're not allowed to ask the same question twice. So that
I like that.
Right? The guy who told me that would say, people will know that you're stupid if you ask the same question twice. But there is no dumb question. And so everybody's seeking an answer in the markets. They generally want to know, what is the answer? What is the answer? How do I make millions? But I would suggest that you're competing against the smartest people in the world. And this is the ultimate game with the smartest players. And this game is ever changing and ever evolving.
So you know what the floor had? The floor had an ecosystem of old people teaching young people. And when the exchange went electronic, that handing down of knowledge, which was actually like the family farm, people would just learn. You'd come, get 19-year-old person come to the floor. He would work his way up from being a clerk. It was a true American dream. You could actually start from nothing, not go to college, come from a working class background, and be standing shoulder to shoulder with the kids who came from Harvard. And if you were smart and you could learn quickly and adjust the stuff on the fly, you could make it. And so now when the exchanges went electronic, they lost the entire knowledge pool. And through the magic of video, we'll be able to, and our experience will be able to pass on some of that experience to anybody who's willing to listen and change for their own right. If you have a friend and they pay attention to what you say, right? They're a good friend, right? If you have a person that's working for you, what's a positive character trait? Somebody with courage and curiosity, right? You also need a sense of humor, because in this game, 8 out of 10 people fail. So you better have a, look on the bright side of life attitude if you're going to try. And you see it among all of us older traders, is that, oh my God, there are actually now young people for us to pass down the knowledge that we learned. We're not going to go to the grave with it.
So why do you think the floor no longer has any education being taught? I know that's a big question, but...
Floor is only interested in cars through the toll, so to speak. They want to get their fraction of a commission. And what they did squander, it was like if you stand in line at a ski area and you look around and you see people who used to be former World Cup skiers standing in line. And you're like, wow, the ski area has all this knowledge, but they're not doing anything with the people here who love the sport. And in our case, all the old guys who you're going to talk to love trading. And so it's kind of a win-win, right? Because it's nice for us to dump the knowledge onto you, and it's nice to see the fact that you actually can get smart and learn and survive on your own as a trader. And that's a necessary skill, right? Think about why do people got to learn to trade? Because interest rates are zero. If interest rates are zero relative to the price of inflation, every dollar ever printed has to be traded. Right? So you have to know. You got to know how to trade. I taught some sort of how to think about what happens when you hit the mouse. In other words, you hit the mouse and then all of a sudden every trade is either going for you or going against you, and you need to remove the sense of cheerleading for a position that's just bad form. In order to see the market clearly, you have to put the trade on and then observe the market as though you're an impartial observer of the market. If you're not going to see the market clearly if you're cheerleading your own position. We used to say to people on the floor, we'll get you some pom-poms all the time. I would say find the oldest traders you can who have a real world experience on the floor, and then listen. Just be a sponge. And remember that the name of the tune is to stay in business. So you want to surround your people who have stayed in business.
Okay, my name is Steve Hawkins. I've been involved in the markets since the mid to late 80s. I've been involved with my business partner, Peter Stoudemire. He's the creator of Market Profile. I got involved with the profile and trading through a mutual friend of mine from high school. Back in the day, I was a decent athlete, and a lot of people still believe that athletes can become good traders. So he approached me and wanted to know if I wanted to get involved in a business entity he had, which was working with Peter Stoudemire and developing and educating the community on Market Profile. So I took him up on the offer, and one thing after another, I kind of educated myself on the process and got involved in the business and doing some things as far as educating individuals, educating institutions, doing some brokerage, and then those two had a falling out, and I started working more closely with Peter, developing the Market Profile ideas and educating the community. And we like to tell people that the profile, it offers off-the-floor traders and on-the-floor perspective. So it's a way to visualize the price action. Back then it was a pit. Really visualize the price action that's occurring in an underlying instrument. As the markets are accumulating prices horizontally, you're building a profile. Where there's a lack of letters, that's a situation where the market is not accepting those prices. And you can kind of visually see some type of a Gaussian distribution, a bell curve, and this can give you a perspective of how the market received the price action. If it is an influence or an influx of buying coming in the market, you're going to have some type of a vertical move higher with less letters, and if it's more price acceptance, you're going to build letters horizontally. And that's essentially what a profile is.
The following lesson is about the very fundamental purpose of a marketplace and defining what a stock is and how they're bought and sold. This lesson will become the new building blocks for what Chris will continue to explain throughout the entire course.
A little bit before we get going is a little bit of the backstory of how we got here in regards to the market. And what we're going to teach today is essentially the economic conditions to how we got through economic conditions to where the market is and the way it behaves and the way it acts today. Not a algo or not a secret black box, but real world stuff that you can literally tell someone across the dinner table and they'll be like, this makes sense. So, Gentlemen.
Hey, I like
Thank you
it.
for having me.
Me too.
Yeah.
It's our pleasure. And I think it's appropriate that we start pretty much from square one of what is the purpose of the market. Because I believe if someone can understand what the purpose is, it'll help them. That's the first step in understanding why and eventually being able to predict where a market will move. So what is the market's purpose?
It's not Vegas, right? In the old days, right, they used to say the stock market was for the formation of capital and the transfer of risk. Okay. And that was what they told me when I got there. That meant if you had a company and you needed to raise money, you sold a piece of the company through the market and you got money to expand. So you, in a sense, you got money and you kind of offloaded some of the risk of your company. But the real purpose of the market is to facilitate transactions. In other words, it will go to where the most business is to be done. If there's no business to be done at lower prices, then the market will go to higher prices. So it's interesting that the market has a purpose. Most people just think that it functions as a casino or as a place that people trade. You need to integrate in your thinking that the market has a purpose, and that purpose is to facilitate transactions. And that will make more sense as we move forward.
Do you want to talk about how these transactions are facilitated? You mentioned clearing firms and how that works, kind of like as an example, when you write a check to someone, what happens when your check is cashed?
Right, and so your money gets electronically transferred vis-a-vis the banks, right? Yeah. And so the same thing is called, in the stock world, it's called a clearing firm. And so when you deposit money with a front-end broker, for example, and we have no affiliation with Robinhood, but we're just using it as an example. If you were to put money with Robinhood, I believe that money sits at JP Morgan. or perhaps a couple different clearing firms. And so it's important as an investor, trader, or as a young participant just learning the game that you understand the difference. The point of this conversation is so that you understand the difference between a clearing firm and a broker, okay? Yeah. And some clearing firms are in fact brokers, and that's probably a good thing to know, okay? So clearing firms are different than brokers. The clearing firms transfer your money between you and the other party like a bank clears your check. Okay, this is just plumbing stuff. Yeah. That's no big deal. Mm-hmm. But if you want to be taken seriously in this game, you have to use the right nomenclature. Yeah. So we're just crossing that off the box.
Totally.
When I first started on the floor, I was like, well, the stock is worth X, and I was like, well, wonder what worth X means. And someone explained to me, and it's an interesting distinction. The stock is valued on the future profits, the future expectations of profits, not the company's assets. In other words, if the company owns 1 billion acres of real estate, the stock is not valued on their 1 billion acres of real estate. The stock is valued only on the future perception of profits. So stock is actually the rights to the future profits, only the profits. So if the company's not going to make money, the stock's going to go down, no matter what they own, right? That's not relevant to a stock. And that's an important distinction I think most people don't understand. It's just that, and it's just something, you want to make sure that you're speaking the language and that this is the story. The stocks are related only to the company's profits, which is kind of interesting if you really think about it. It's not, are they cool? Do they own a lot of things? Do they have good ideas? But it's what they will earn, not if they own a lot of things.
Exactly. So why does the market move in the first place?
Everybody has an opinion, no question, right? We could ask anybody on the street, what do they think of the price of gasoline? And they would say higher or lower. Yeah. Everybody has an opinion. And so the market does allow people to express their opinion. And a lot of people like to so we say, bet that way. Mm-hmm. And so, and then for years, there had been people who value the price of a stock. In fact, here I'm currently located on Wall Street. There are industries of people who measure what the sales are, analyst ratings on stocks, and all of that is quantified, and they could boil them down to ratings. So sometimes stocks will move, to answer your question, why stocks are doing what they're doing. It's first the expectations of profits in regards to the future. Okay. Right. Everything is market. The market is a discounting mechanism. In other words, so it's always trying to seek what's over the horizon, over the next roll. If we were skiing, like what's on the backside of that blind spot. And so, there's a cliche here on the exchange, and was like, why are stocks going up? And people would say, because there's more buyers.
Makes sense.
And so if you want to be snarky, you could say, why did stock go down? You could say, well, there's more sellers. And people are like, wow.
Yeah. Smart.
Right? But don't you think, you guys, and we've agreed on this in the past, right? We're like, what's the question? It's more important is where are stocks going, right? And you guys chimed in and said, well, and how are they getting there? Are they getting there quickly, or are they getting there slowly? Mm-hmm. Right, which is interesting, right? Because that brings us to the speed of something through time. That's the relative metric, the speed of something through time. People need to know why they move. I would suggest that the answer makes you late in trading. So worry first about where they're going, and then why they're going we can talk about over a beer.
All right. Okay. Just to reiterate what Chris was saying about why asking ourselves why a stock moves is not important, is because according to the efficient market hypothesis, everything is already priced in. So we shouldn't concern ourselves with asking why, because by the time we know why, the price is already moved. As traders, we are supposed to make educated guesses about the future of price, not what has already happened. So asking why is nonetheless pointless.
All right. Okay. So maybe we can rephrase that and ask, how do they move?
Lately, they move quickly, don't they?
Yeah.
right? And so today I saw the S&Ps rally 13 points in 2/100ths of a second, officially 2/100ths of a second. And
Whoa.
so there's a narrative associated, right? There's all sorts of conspiracy theories, but how they move in the larger perspective, if we want to go back to the way they used to move versus should we go down that road of the way they used to move versus how we ended up where we are today?
Yeah.
Yeah, I think that's a good point to touch on.
Okay.
This is the first part of a two-part series that dives into market auction theory and the concept of balance to vertical, which will be a major theme throughout the entire course. In this video, Chris will explain how prices used to move versus how they are now using the lumberyard analogy.
In pre-internet, pre-1994, and probably had to have been for 500 years, I guess they did commerce back in the Middle Ages. A lumberyard prior to the internet had to keep lumber in the lumberyard. People needed to go to the lumberyard to get lumber. So and then as the price of lumber grew cheap, the guy who owned the lumberyard would stock up. That's what you did as a retailer, as a vendor. And the price dropped, you'd stock up on lumber. So we would say the yard was heavy with lumber. And then as the price moved higher, you would let the yard you would sell your inventory. And as the price moved even higher yet, you would essentially let the yard run light instead of, which is the opposite of heavy, right? When the price was lower, you'd let the yard go heavy. And when the price got higher, you'd let the yard go light. And essentially what you're doing is you're becoming a buyer of dips in price and a seller of rallies. And if you were to imagine a bell curve distribution around that price behavior, it would look like a standard bell curve, right? Not much time at the lows, not much time at the highs, and the bulk of the time spent in the middle of those two price ranges. And that's what's called a horizontal distribution of prices. And so because of the need for everybody to have inventory, right? These are real economic conditions, right? They needed to have inventory, whatever store you had, right? A grocery store, a clothing store, an auto parts store, a lumber yard, even employees in the firm, right? Even with the number of employees they had, they would distribute around a normal balance point. And so that was called a horizontal distribution. Looks like a standard bell curve, no big deal. All of a sudden in 1994, here comes the internet.
Good.
And so everybody remembers that, right? It was
Yeah,
just like,
and it changed
right?
things. Right.
Changed things a bit, right?
Yeah.
And so these are real world economic things that are happening. So think about it, right? For 500 years, people would have to stock inventory in their store. The internet shows up and nobody's got to stock inventory now. Everything's lean and mean. Amazon shows up. Mm-hmm. And so the lumberyard guy now doesn't stock up lumber when the lumber gets cheap. And he just keeps the bare minimum in the yard. So guys, here it is now, age of the internet. And the guy walks into the lumberyard and says, I'm going to build a condominium complex. He's a contractor, you know?
Mm-hmm. Yeah, he needs a lot of wood.
He needs a lot of wood, like a trainload of wood, right?
Okay.
And so the guy at the lumberyard is psyched. He's got this huge order, but he doesn't have the lumber. So he's got to call the broker. And the broker, they trade lumber on the exchange on the CME. And so that broker calls the CME with this big buy order. What do you think happens to the price of lumber?
It's going to skyrocket.
Right?
Yeah.
It's going to skyrocket. And nobody knows how big that order is. Right? Nobody knows, right? So this is a real world scenario, right? This probably happened a lot and probably happens to this day. And so that guy, he buys his lumber, the price skyrockets, and the broker calls back the guy at the lumberyard, and the lumberyard owner picks up the phone and gets the price, adds 10% because that's what his VIG is, and he turns to the contractor and he says, here's your price. The lumber will be here in a week for his trainload of lumber. Contractor's happy, right? Got his lumber. Guy who owns a lumber yard, very happy. And now what's happened to lumber? It's skyrocketed.
Yep.
And everybody's standing around because that order's done, right? That one big trainload of lumber has come and gone, and now the price is higher.
Yeah. And now it's going to balance out.
Right. It's going to get balanced out, right?
Yeah.
And everybody's now kind of like, okay, well, that was that, right? And so you can see that happening in the market now when we trade, and it happens. It's that sort of just-in-time inventory has created a environment as what would we call it, gents?
Horizontal to vertical.
Yeah, and that, or vertical to horizontal, or horizontal to vertical, and what's interesting is that the next order that comes could be in no relation to the prior direction of that. So the first guy was a buyer, the next order could be a seller. But since there's just-in-time inventory happening, every business and every country, even when they need things, and this whole sort of just-in-time inventory and capitalism around the world has created this cycle of vertical to horizontal that's reflected in even the price of stocks. You can see it in other commodities. The idea is that we wanted to share with you the reasons for the way the markets are moving between this vertical and horizontal pattern or cycle, which is called auction market theory, and so that you can go out in the real world and look for it happening in other places besides the market and explain it to your friends as well. And so, because once you can explain it to somebody, then you're really in a position to be able to actualize it in regards to seeing it in your trading. What do you think the next challenge is, men?
Finding a way to measure balance would be the next.
Right, because we know. That's exactly right, because we know from a balanced position that you're ready for a vertical move.
Yep.
Right? And what's interesting is that a balanced market can stay balanced, right? Okay. It's not just because it's achieved balance doesn't mean that it's going to go vertical immediately.
Yep.
But you do know by default, right? That's a key word there, by default. Mm-hmm. A balanced market is about to go vertical. And so market going vertical only happens 15% of the time. And the other 85% of the time, the market's trading around a balance point.
Okay.
Isn't that interesting?
Yeah, it's interesting. Well, you can just imagine the power you can have over the markets if you can understand when it balances. Because I think a lot of the fallacy with learning how to trade is you enter, this industry and you learn all these weird indicators and techniques and strategies, but no one really takes the time to understand how the market functions, why it functions, and where it moves from a thought out and logical, exactly, from a fundamental basis. So,
right, from what we were calling economic conditions, just in the real world. Like, this is a transformation that occurred in real time, and we saw it happen, and you can explain it to other people. Yeah. And it makes perfect sense. And so imagine now as a trader, your first diagnostic skill in the morning is the market balanced and ready to go vertical, or is it still out of balance, right? And so the corresponding strategies that go with that will touch in another segment. But it's important that everybody grasps the fact that you have a blueprint for understanding where, I guess you could say, where the market exists within that vertical to horizontal cycle, as my co-teachers have said, and then the strategies associated with where you are in that cycle are also a huge advantage to people who just show up and are going to walk through the door and say, let's see what today brings.
Yeah.
Right? Because you need to be able to have some structure to lean against.
Yeah.
Right? That makes you so much stronger because you can't be perfect. So if at least you're in step with the structure, you have some sort of thicker skin to sustain a price or time move against you, as long as you're in step. Remember, our job is to be in step with the market. It's like we have to dance with the person that brought us.
Yeah. I like it.
No matter what we really want, it's not going to get us, it's not going to get us anything other than. And so, gentlemen, right? Vertical leads to balance, right? Horizontal. And then just because the market's balanced, the term is by default, we're ready for a vertical move. Just because the market's balanced doesn't mean it's going to go vertical, but by default, the first step is first defining balance.
In this second segment, Chris talks more about the importance of balance to vertical and why they are significant in the marketplace. These are all subjects that will be broken down later in the course, as this lesson is more of an introduction and concludes with Chris talking about the realities of trading.
The first step is first defining balance. So let's freestyle it. Like, how could we define balance? Moving averages? You could kind of, maybe. Volume profile? Maybe. Maybe, right? Like, what would be balance? Sideways, right? The market was going sideways, right? You'd say, okay, it seems like a lot of people agree this is a fair price. That would probably lead us to think that it's balanced.
Yeah.
Like, some, maybe a chart that looks like an ice cream cone on its side.
Yeah.
Right? Like, it goes from wider to skinnier.
Yeah, I think we could go on forever about ways to, or not forever, but we could definitely go on and break down different ways we could find a balanced market. And I don't want to limit ourselves in how we can explore that subject, because obviously it's very important from a fundamental basis and how a market moves. So
what does vertical look like?
Yeah, what is vertical? How do you know when the market is in a vertical? Because you say, I've heard you say this before. What is the % chance of a retracement from a balanced position to a vertical position?
Think about it, right? If we're in a balanced position, everybody's like, this is cool, this is where the price belongs. Everybody's chill.
Yeah.
Then someone just shows up with a ginormous order.
Yeah.
They're not tipping their hand, right? They're just like, they're just like, okay, I'll start to buy, right? And people are balanced so that they don't really have much skin in the game. Or if they have a position, say they're short, and then the market all of a sudden starts to go up. Okay, then they're like, whoa, I got to cover. Right? So they're immediately buyers and they're in a hurry. Well, don't forget there's also another guy who's got a huge order to buy.
Yeah.
Right? And he's not waiting for the other. He's not being polite. Right? This is when the market's moving from a balanced position, people are trying to control their losses. New people are trying to get involved, and the guy with the original guy or woman with the original order is also buying them as fast as they can. So you have to recognize that leaving a balanced position, there is zero chance of a retracement, which is so different if you were just chopping around balance, right? Because we're just chopping around balance for a day or two, and then all of a sudden things start to happen, and most people are just still in a state of kind of like, oh, it's just chopping around, and then so it starts to move fast.
Yeah.
And like we were talking about, it's the safest place to put on a trade if you're on board early. There's zero chance. Isn't that interesting?
Yeah, it's something you never hear in trading. It
right?
Doesn't make
like
sense.
It's like, here's something. It's impossible to get on board, but if you do, it's impossible to lose.
Let's see. Well, I think that was a great first. That was a great first segment, kind of introducing what we're going to be teaching, and in terms of you are kind of like, how long have you been involved in the markets?
Since I was 19, and so I'm currently 62 years old. So that's 43 years, and I haven't gotten a paycheck since 1986.
Wow.
So if you give this skill to people, they need this skill. First of all, interest rates are way below the rate of inflation.
Yeah.
So that if someone is young and they're starting out, and the difference between them getting 10% a year on their money over a 20-year window and them getting 2% on their money for 20 years.
Yeah.
Think about, right? That's a huge,
crazy,
right? They're the difference in wealth over that. So the skill, the point is that what we're trying to accomplish and teach, all three of us are trying to accomplish and teach, is this skill that once people learn, just as a plumber becomes an apprentice and works his way up, here as a trader, you have to start at the bottom. In our case, the markets are evolving, so we're teaching not only today was about what had worked in the past, but what is working now, and then how we perceive what will things be like in the future. But that skill, I think, is a mandatory requirement for at least financial stability as we get older and in the future. So cheers to all the people watching. I think that the time invested is a very valuable skill, whether you take it to trade or at least you have knowledge about it, so you can make sure you don't learn the wrong things.
Yeah.
Yeah. Well said.
I agree.
Awesome.
Well, I'm excited, and this is just a start. If you're joining us, I hope
Please
you
come back.
Yeah.
We promise to keep it entertaining
Yeah. And like,
and real.
yeah.
We have reasons for everything that we teach. It's not some secret sauce.
Yeah, I mean, all I can say is you're in the right place. This is
This is the right place, and this is
transparent.
and the younger you are, the better, for
Right.
sure.
yeah.
So get excited.
All right.
Yeah,
Start.
it's real.
Awesome.
Right.
On to our next module.
All right, see you guys. See everybody later.
Awesome.
Later.
Bye.
I just want to take a second to interrupt this episode. I hope you guys are learning stuff so far, but I do want to give you an opportunity. Now, I'm going to be trading every single morning. I'm going to be live. You're going to be able to sit and watch me enter and exit positions, executing the system that you're learning now. If that is of interest, I'll put a link in the description below.
In this short video, Chris shows us the mathematical equation which defines balance. He will also introduce the 65 and 33 moving average strategy, which we will pull up in the following lesson on the screen and go over with Chris.
Hi guys. Hi everybody. In our last class, all of us were talking about how the internet led us to the transition of just-in-time inventory, and that led to this vertical to horizontal pattern cycle that seems to be replayed in every market because of both the way the internet works and the sort of the capitalistic bend that all countries are, and now corporations and everybody is following, and when it comes to markets, at least. We understand that we don't really know when the markets are going to go vertical, and we don't really know when they're going to get balanced. But first, we figured out that we needed a way to get at least measure balance in the market. We mathematically created a mathematical formula for balance, which would be if you have price on the left-hand vertical scale and you have time on the lower going out right as time goes chronologically. And we created this formula where if we take time and we divide it into A and B and make it open-ended, and both A and B are equal, but open-ended, and then we use price, and the formula is this, that the range in the A section of time is greater than the range in the B section of time, and time is open-ended. So all you programmers out there can actually program when the range in the A section is greater than the range in B section, and time is equal, right, you guys? You know that, right? The range in A is greater than the range in B, and time is equal, right? And that's your definition of balance. And so for people who aren't necessarily going to program that into their box, what happened was we did that formula, and it kicked out about 130 to 140 half-hour periods for a period of 2 years. In other words, that's an open-ended study. We're letting the market define itself through those criteria. There's no time limit on that. And so given that it took between 130 and 140 half-hour periods, true story, after the Trade Center came down, I needed a way to create that sort of understanding of the timing in that cycle, and I didn't have anything because we had to go to a warehouse in Long Island City, and so I just lopped them in half and put moving averages together. And so it's the way to do it quite quick and dirty is to use a 30-minute chart and then use 65 and 33 period moving averages. Those are exponential moving averages. EMAs is what they call them, exponential moving averages. And again, those periods are 65, which is half of that 130, and 33, which is half of the 65. And we use 30-minute bars. And you can use that on any stock or any commodity. And when the lines go flat, right, you guys, when the lines go flat,
Yep.
what's interesting is that the vertical only happens 15% of the time, right?
Yep.
So there's considerably more time being spent in the balancing here. I'll bring up a...
In this lesson, we talk about the importance of the market cycles and how we should adjust our strategies to the 85% horizontal and 15% vertical rule. A lot of this theory is explained using analogies in nature and how it applies to your trading.
just share my screen. And so in this case, this is the S&P, which trades 24 hours. On the bottom is a simple oscillator that measures the differences between the moving averages. But when the lines go flat is essentially when the market's balanced. And so you can see here before the Fed announcement that the market actually it makes sense, right? If the Fed's going to do something, people would generally get flat and the market would be balanced. And then as the moving averages draw farther apart, the market then tries, at a certain point, the market tries to get in balance again, right? So remember we had, in the prior class, we were saying that horizontal behavior leads to vertical, leads back to horizontal. And so just using these moving averages is just a quick and dirty tool for it to demonstrate that the market is balanced. It's not a crossover system. I'll say that again. It's not a crossover system. And so by looking at these, right, you guys, that you are either in balance or and by default ready for a vertical move. If you're out of balance, then the job becomes trying to determine how far is too far and when will it start to revert to the mean and begin to get balanced again. I'll say that again. When the market's finishing up a vertical move, your job is to determine when you would want to start to use what we're going to teach you today is the reversion to the mean program. And so 85% of the time, the market is getting balanced, and only 15% of the time the market's moving in a straight line. Now, if you're coming from a balanced position, you would assume that the market's going to move in a vertical line. You would not want to use a reversion to the mean program when the market's moving vertical, right? Because essentially the reversion to the mean program would be, what would it be like in nature?
Kind of like the tide going in and out.
Right, or sun coming up or down, or the seasons changing and such like that. And it was great. That's a great analogy. The tide coming in or out.
Or how about a traffic light turning green or red?
Right. The same sort of thing, right? A predictable sort of just. It's no secret that the tide comes in or out, or that the traffic light is going to go red, green, all the time, right? Yeah. And so the markets are the same sort of thing. And they do that 85% of their time, which makes you think that you could use this all the time, which is not the case, right? Because as you can see in our chart, when the market moves vertically, it really moves vertically hard. Yeah. And so most people are looking to capture the vertical, though it's very difficult to do for most people. And most people don't understand that the market goes through this cycle of horizontal, vertical because of the way that everybody runs lean and mean just-in-time inventory. And you see that both on the upside and the downside. When somebody doesn't need a stock that they have, if a portfolio manager doesn't need a stock because of bad numbers, they sell it down in the hole. Yeah. And everybody just runs lean and mean.
We were talking about Bollinger Bands and how that can be another indicator you could use.
I mean, there's probably out there in the world, there's probably other ways to measure balance. And I encourage everybody out there to try and think of a way that they could measure balance, because I think that's the starting point here, right, you guys?
Yeah. With Bollinger Bands, so if the Bollinger Bands narrow, it would be a sign that the market's getting balanced.
And you are now our resident expert.
Yeah, I know. Look at that.
Right? And so, in our case, moving averages is a quick and dirty way, and Bollinger Bands may be more exact. And you could probably use volume profiles on the screen, right? Don't you think, you guys?
I think that almost deserves a whole unit later on in the course, and how, or maybe more than that, we're bringing on Steve Hawkins, who's an expert in market profile. Volume profile is very similar to market profile. So I'm sure later in the course we will definitely touch on volume profile and how that can be used to measure balance, reversion to the mean programs, and detecting a vertical move.
I'm sorry, go ahead.
Yeah, I just wanted to touch on real quick about how balance in time is not necessarily a finite thing, right? We were talking about you made a reference to the dog and in the C and the I don't remember, but it's like, balance can be measured on a micro scale. Balance can also be measured on a intraday or a swing.
Oh yeah, the flea on the flea on the flea on the dog, right?
Yeah.
Right? Like this whole principle of balance to imbalance or vertical to horizontal goes from even at the microsecond level. So whatever your flavor of trading is, if you're looking at your screens at night, you can use a longer time frame with that. And if you're glued to the screens like many professionals are, you can bring it down to even a 5-minute level. Mm-hmm. But that principle works even down to the sub-microsecond level. And so it's just the way business is done and the way the exchange works. That's a very good point, you guys.
Yeah, I'm glad
really
you brought
solid.
that up.
Yeah, thanks for doing that. So I mean, that's the flea on the dog, right? Like the microsecond period moves out to the second, moves out to the 1 minute period, moves out to the 5 minute, the 15 minute, the 30 minute. Mm-hmm. And as an aside, the people who study that sort of stuff always say that the longer duration stuff always wins against the shorter stuff, which we don't have proof on that. We'll have to look at it coming down the road in the future, but let's stay on topic, right?
Yeah.
So we got this idea that all right, so at least we're measuring balance. That's the first step, mm-hmm. right? Because when we're balanced, by default, we're ready for a vertical move. Like you play this, you use reversion to the mean as long as possible, even when the market's balanced for a little bit. But you recognize as the market's achieved the state of balance, by default, it's ready for a vertical move. It doesn't have to go vertical. Balanced market can stay balanced, right? Say that back to me, right?
A balanced market can stay balanced.
Yeah.
Right?
Yeah.
By default, it's ready to go vertical.
Yeah.
Mm-hmm.
And so that's probably not, that's when it's very dangerous to use the reversion to the mean pattern that we're talking about. It's the process of the market getting balance, which takes 85% of the time, which is the tools that we're going to provide today. And it's similar. Remember, it's the tide coming in, the tide going out. And you see that all the time. Mm-hmm. This is an interesting concept, you guys. Like balance is not a static thing. It's not like a tree sitting there, right? Like these are prices and they're moving. We need to be cognizant of the fact that this is a changing world and that sometimes price is behind what fair value is because of news or something like that. Mm-hmm. Mm-hmm. And so while we have a reversion to the mean program and we're using this reversion to the mean to trade around what we use as what we would consider the mid-tide point, in other words, the halfway distance between the low tide and the halfway distance between the high tide would be the metaphorical mean price.
Yes.
Right? Now, the tide doesn't necessarily move like price does, but the concept is the same. I'm just saying that we're providing a tool, mm-hmm. and this will work 85% of the time, but we need to be cognizant of the fact that things are moving.
Yeah.
While we do this.
Yeah, things are forever changing.
Right. Learning is a very, very, very messy process. And so in regards to trading as well, it's not exact engineering. It's kind of messy. Mm-hmm. So we understand that we're going to have what is a mean, and we're going to generate a mean through a moving average, and then we're going to put an envelopes stacked around that. And then imagine, right, that a stormy day, the surf gets bigger. We need to make the envelopes wider as the surf gets bigger.
Yeah, I like that.
Right? Does that make sense?
Yeah.
Right, so we're going to adjust. Always remember that the key point about all these trading strategies is that we remain flexible and curious, and we don't say that this is the way it is always going to be. Mm-hmm. And so all these trading strategies that we will work on all have the ability to be customized and are all very easy to do. So currently on my screen is the 65 to 33, and the idea was that you can recognize balance, right? And before we just leave the screen, you see that now here, after a vertical move, here's this vertical move from the CPI. And then you can see this is the S&P 24-hour market. And you can see that the market then, after the vertical move, becomes horizontal until the moving averages come flat together again, and then it goes vertical again. And that's how you use this program, okay? And over time, it's very easy to make, and it's not a perfect science, but you'll get the idea that the market will get balanced after a vertical move and then move vertical again and then try and get balanced. And you'll see here again that the market was balanced and then went vertical. And it's all because of that economic reasoning we were talking about just-in-time inventory. And this would be considered a reversion to the mean program. Okay.
Hello everybody, I just wanted to show you all how to add the 65 and 33 moving averages to your screen if you did not already know how. If you already know how to do this, I'm going to show it specifically on TOS. However, most of the charting systems interfaces are very, very similar. If you already know how to do this, feel free to skip ahead. This is not for you, but for those of you who don't, I want to show you. So first, what you're going to do, you're going to go to Studies in the top right here, and then you're going to go to Edit Studies. You are then going to look up exponential moving average, and it's going to come up, and then you're going to click moving average exponential, add selected, and hit add selected twice. You are then going to go to the settings icon, and then you are going to type in 65, okay, and then 33, and then what you're going to do is change the color so they're not both the same. Just do like blue and yellow, that'll look nice, and then apply. So then you make sure you're on the 30-minute profile, and then look, we're almost in balance. So I could try to explain this, however, Chris will do a much better job. So back to Chris.
In this lesson, Chris goes over a basic relative strength and mean reversion strategy, and how to use it in your trading specifically.
And so you can see that there's many multicolored bands.
Yep.
And see the center blue?
Mm-hmm.
Okay, the center blue would be the halfway between high tide and low tide. And then the corresponding light color, see, they all match, right? This blue matches that blue.
Yep.
Right? And so you can see, remember how we were talking that the mean moves. Remember, this is the blue line, right? The mean is moving.
Okay.
Okay. And then there's many intricate ways to trade these things. We'll give you all the properties and all the parameters for this right here when we finish. You can see, for example, one of the ways you would trade this is, see here it gets to the yellow, and see here it makes a higher price, but doesn't get to the green.
Yep.
Right? That would be a sell signal, right? Because this is a further band from the mean, and this is a higher price at a lesser band.
Yep. Yeah, there's no follow through.
Right, and then you see how it reverts, goes back to the blue.
Back to the mean.
Right, back to the mean, because it demonstrated here that it had lost some of the power. It didn't get to in the context of an uptrend, it didn't get to the prior yellow. It only got to a little bit less than the green, and down she goes.
Yeah, and then look how on the up move, we see it from where it was, that was kind of at the 1330, 1430 period. You see it reach up to the red band and then continually move up to the green band and have follow through.
Mm-hmm. And then see here on the downside right here, see how it doesn't get to the yellow, but makes a lower price.
Yeah.
See that? And then up she goes. And what's interesting is usually they go from one to the other, from green to green, which is kind of interesting. And if anybody can explain that to me, I would love to know. But see here, from green to green.
Okay. Wow. Okay. It's interesting.
Isn't that interesting?
Yeah.
And show you another one here. This is a larger scale one for other people. This is a 151-minute chart. It came from this guy who lives on his boat in New Zealand. I saw him predict where the S&P would be 9 months before, to the day and to the price. And I'd never seen anybody do that ever. And so I reached out to him and I said, what chart should I use? And he said, use 151 minutes. And I said, 151, okay.
Okay.
Okay. And then I just decided to put 151 bands on you guys can't see the parameters, can you?
No,
I can.
Yeah, we can.
Oh, you can. So this is 151 minutes. I used a 151 period moving average on a 151 minute chart. And then I put envelopes of 1.51, 3.02, all measures of 151 in the envelopes.
Wow.
And so you can see it works to the tick.
That's crazy.
Isn't that crazy? And so
This is some major secret sauce.
So there's,
Yeah.
you can get very creative with your reversion to the mean strategies.
That's
and
really
this
cool.
is obviously a larger scaled version of the one that we were just looking at on here on page 14, right? These are 10-minute bars.
Okay.
Okay, and so if someone's an active participant in the market, these 10-minute bars, and let's bring up the proper. We'll pass on all the parameters, and these are fib numbers. Fib numbers are the Da Vinci Code stuff, right? It's the tree rings. It's the your ratio in your eye, the iris to the iris to the eye. A wave breaks. The curl of a wave breaks. The curl of a wave breaks at a fib ratio. Sorry for the people in the background.
That's all right.
In this case, they work for reversion to the mean. And of course, nothing is perfect. And of course, around news and things like that, markets will move. And you can see here during the Fed announcement, right, where during these craziness,
Wow.
as well as when the market's going to go vertical, a reversion to the mean program is not the right tool to use, right? 85% of the time, the reversion to the mean program is the time to use it. And so in this case, so programming it here, let's just run through the quick programming things, right? You bring up this case, it's a 10-minute chart. You use an exponential moving average, 8 periods. I have it here, high, low, and close. Okay, and that you put on a particular color, right? And so here you can see, right, this blue line is just an 8-period moving averages. And now we've gone through all these different parameters for years. So just so you know, we haven't made these up. We've tried 13, and again, these are fib numbers, right? The fib is 1, 3, 5, 8, 13, 21, 34, 55, 89. And to ad infinitum, where you take the prior number and you add it to it. And so anyway, it's a 8-period moving average is the blue line. That's what your mean is going to be on a 10-minute chart. And then these are envelopes. And you see here it says an envelope top or bottom. These are standard in pretty much any front end that you get from interactive brokers. This is CQG. There's Cunningham, and I'm sure all the TD and other places have this. And these are just the fib parameters. You can see 0.382, 0.618 are fib numbers. I needed a narrower band. I split 382 in half to 0.8181. And I needed a wider one, and then 1 for the last envelope there. This is the shorter term reversion to the mean strategy. Check this out, right? You guys see how this thing is making lower lows on a lesser band closer to the mean.
Yeah.
Mm-hmm.
Oh, yeah.
Right? And that would be the situation where you would say, okay, now I think I can use, it's starting to demonstrate the ability for it to go sideways.
Yep.
I see.
Right? So you see it oscillating around the blue bands, right?
Yeah.
Red to red to red to red.
Mm-hmm.
Right?
What I like about this strategy is that obviously there's a million different trading strategies out there, right? Whether you use moving averages or relative strength or certain oscillators. This is something that it's designed to be used in accordance with another strategy, right? You say, okay, I'm going long on a certain ticker symbol. You might look at the reversion to the mean and where it is and its relativity of whether it's balanced, or trying to identify what type of market are you in? Are we balanced? Are we moving right now? Where is the direction? This isn't something that you just look at, right? It's something that you use, and you use it in coordinates with a sediment.
Right, exactly. You're exactly right. If you look at this and you use it, for example, you always want to get good location, right?
Yeah.
If you have a feel for say a particular name, or even the indexes are going higher, you have a feel for that. You can know that if you're buying them above or below the mean, right? If you want to buy them, you probably want to buy them at low tide,
Yeah.
rather than buying them up here at high tide.
Thank you. Yeah, you finished my sentence. Appreciate it.
Right, yeah, no problem. You guys, you have the right idea. I can just enunciate it a little bit better. And so your gut feel is perfect in this case.
Yeah.
And so, right, you know, maybe here you're not so convinced that you want to own them, right? Because look, it's just come straight down,
Yeah.
right? You're like, oh, but after it goes sideways a bit, and you see that it's having a hard time making lower lows, and it's holding this red band, you may take a stab here for the trade.
Mm-hmm.
And you can see that at least you get the red, and in this case, you get up to the green. And then look, when it goes from green, it comes right back down to the other green.
The range.
Right? And so people, you can trade this if you let the market tell you, right? Essentially, our job is to be curious and be in step with the market, right? That's what the whole thing about balance is, right? We want to be in step with the market. And then here is a case where we're learning a reversion to the mean strategy, because 85% of the time the market is reverting to the mean.
Yeah.
Right? It's only in these big vertical shots. You see this big vertical shot, how it never gets close to the blue?
Yeah.
Yeah.
That, right? See that? So you do not want to be buying them here looking for the blue.
Yeah.
When it's
That
getting,
makes sense.
right? But when you see that it's starting to do the balancing thing, you see how the reversion to the mean thing works?
Mm-hmm.
Right there. And so you can pay the rent. And part of this game is making sure that you're staying in business.
Yeah.
And so having that strategy, we don't just, everybody has a particular tool. This is a tool that you'll use. Now you know when to use it. And you need to incorporate this. This is the first strategy that everybody needs, is a good reversion to the mean strategy. And you just need to make sure that you find one that works. You're more than welcome to use this one or the one that's 151 minutes. Or if you discover a better one, please let us know. Some people use a VWAP, guys, right?
Yeah.
Isn't that interesting? Like, because they're figuring that the VWAP, the volume weighted average price of all the trades that have happened, is the best mean. Some people use a 200 period moving average on a 1 minute and build stuff around that. Are you a Formula One driver, or are you driving a super tanker?
I just want to interrupt this episode to give you guys a special opportunity. Now, I'm actually going to be trading live every single morning. If you want to sit over my shoulder, watch me enter and exit trades, and put this system into practice, I'll put a link in the description below, and I hope to see you over there.
In this lesson, I asked Chris how to apply the envelopes to my own time frame. Chris walks us through how to create the strategy so you can use this indicator for yourself and take advantage of reversion to the mean. Chris also walks us through a chart and dives into the psychology behind market participants. What would this look like on a 4 hour? We'd have to recreate.
Here, let's just type it in, 240, right?
Yeah.
So we need bigger bands.
Yeah. Okay. Because I'd like to try to create it on the 4 hour.
Right. Yeah. And so we encourage everybody out there to try it with the understanding of the market being balanced. You're at risk of a vertical move, which is where you would not use this. Right. It's just after the vertical move has happened. You see signs of the market's starting to get sideways. You immediately apply this strategy. This is where you're smarter than the average bear.
Yeah.
Right? Because everybody's still looking for a continuation of the move.
Yeah.
Right? And because more people get involved in that vertical move, then the propensity for a retracement happens because you've got more people involved. And then you start to get that ebb and flow of the tide coming in, the tide going out. And of course, it's usually because time is compressed because remember, it's only 15% of the time. So that people who are late to the party are usually the ones, in the case of an up move, buying the highs, when we're like saying, hey, wait a minute, it's not making a higher band, but the price is higher. We're like, heads up, right? These people are late.
Yeah.
Yeah.
Right? You don't want to be late to the party. So,
how would we adjust the bands?
So here, look, we go you go to what is called parameters section of whatever thing, and you go here, and let's adjust these, and we'll make these 2. Okay, and you just learn by kind of doing.
It's 21.
It says 21. Thank you.
There you go.
Okay, and 2. So what is? Should we go with 1.5?
So wait, if someone wanted to adjust, I'm still confused with what are the numbers called again? 0.0, 0.89, 1.5.
Fibonacci.
The Fibonacci numbers. Based on the
fib ratios, right?
The fib ratios you have
you
to
go in-
change based on the time frame you're trying to set the bands for.
Yeah.
No, the volatility we set the bands for.
So it's like you might want to, because you see like on the blue band, it's kind of like they're going outside a little bit. Maybe we would want to set it to like 1.7.
So you just adjust it
Right.
until it looks like
Here,
it
so
matches up.
Yeah.
Well, yeah, let's use a fib thing. What is that? 8.80, right? So we'll make it 1.61. Right?
So you don't have to use the fib numbers. You just did though.
I did just to try and be like, oh, there is order in the universe.
Okay.
One, right? Essentially, it's a thing that happens in nature a lot. No, that's
Wait,
that's 16.
16. Yeah.
1.61.
I'm like, whoa.
Is things a 4-hour time frame? So when you said 4 hours, like, oh, you want to?
I want to try this platform, but
Yeah.
I'm also gonna start applying this.
Yeah, I'm pretty sure you can do this on TOS.
CQG, you can get that CQ Trader for $50 a month for this stuff.
Okay.
Oh, this is CQG what you're using right now?
Yeah, this is it.
Trader.
And so this is the 4-hour. So, I mean, yeah, we can, I mean, it's close right there, right?
Yeah, you might want to do a little more. Try like 2.
4 hours my time.
Let's
frame.
go.
Yeah.
All right, 2. Bingo. Nice.
I think it's important we just take a second and be like, tell everyone that you just have to, like, you don't have to use the fib numbers and that you just
Right.
adjust the numbers till the bands are where you want them.
Yeah.
You just told everybody that.
There we go. Perfect.
Yeah.
Right? You just told them, right? And so you see how we can, this is called curve fitting.
Okay.
Right?
Curve fitting.
Curve fitting, right? And so some people who are quant people who are looking to prove that they have the system that works all the time are sometimes accused of curve fitting and then assuming that this will work in the future. And your gentleman's point is that we're adjusting them to the market as it's moving.
Okay. Yeah.
Okay.
Right? And
Yeah.
so we're going to assume that, look, the blue here doesn't get to blue here, and the next trade is blue here.
Mm-hmm.
See that? Holds blue, where does it go to? Here, and gets to here.
That is crazy.
And that is reversion to the mean.
Yeah. Wow.
And-
It's actually so interesting.
Yeah, I'm going to put it on my charts that I use.
Yep.
Just as
for
kind of
sure.
like a
It's
little separate
right.
thing
It's
I
a
can
tool,
peek at.
right?
Yeah.
It's a tool. You're like, and then you use the 65 and 33 to make sure you know where you are.
Yeah.
In one, for example, here, look at my S&P window. This is the 65 to 33. This is the reversion to the mean program that I run. It's just, I'll show it to you here. I'll bring it back because I already have a program for tomorrow. I have to manually change the days, which is a pain to do every morning.
Oh, depending on the day of the month?
Yeah, the way I have to change the date.
Oh.
But you can see here, and then here, and I use fib ticks. Okay, and so here is, and we'll get rid of the volume profile. And so this is today. Okay, here's the opening right here.
Okay.
Right? And so you can see it goes to red, can't get to red, goes back to red.
Yeah.
Right?
Yeah.
Goes to blue, and this is fair value, right? This is a 200 period moving average on a 1 minute. This is a 1 minute chart.
Okay.
Okay?
And the dotted blue line is that VWAP?
Yes, it's very similar to a VWAP. So gets to red, kind of can't get there, and then it's just like nothing.
Mm-hmm.
Gets to purple, and then fails back to, this would be the fair price. So you would be, look, you're selling up here, close to here, right? You can see when it doesn't get to the line, you know that it's got sellers there, right? And see when it pushes through, and it pushes through multiple times, you know that there's buyers. And what's happening here, right? The buyers are coming hard, and people are using reversion to the mean because what? The reds worked all day.
Yep.
Right? So you see they're working, and then when it doesn't get to blue, doesn't even come close, right? Up they go. But so many people are convinced that this is not going anywhere that they sell it before it even gets to this violet. then it comes back to the 200, goes back here, and see how they're finding sellers above too. Buyers are still here, but they're running into sellers, right? They can't get them, and then wham. If you're getting what you need or you're not getting what you need, right? Think about you go on a date and the young lady has a bad time, you know she's not calling you back, right? And the premise of this metaphor is that people who aren't getting what they need, people who are not getting what they need, are most predictable. Right?
Yeah.
If they're so.
That's true. And then it seems like she had a good time, but
you don't know, right? She seems like she had a good time. You don't know if she's going to call you back or not.
Yeah.
But if you know she had a bad time, you know you're toast.
Yeah. True.
Right? Let's use a stock metaphor.
Okay.
Say you bought 100 shares of a particular name, and you're up $10 on that name, right? Nobody knows. You're getting what you need, right? No, you could be down at lunch having another beer and a burger, right? But if you say you have 1,000 shares of that stock and it's right where you bought it, and it starts to go bad, I know you got to go. I know you got to go, right?
Yeah.
So we use the VWAP we use the VWAP like that, right? Like, oh, look, are they getting what they want? Or people bought them and now they're under the VWAP, and the VWAP is a roof and we know they got to go.
Okay.
So people who are not getting what they need are more predictable, strangely. Isn't that funny? People who aren't getting what they need are more predictable.
Yeah, I think that ties into, understanding, all right, the market found buyers here. Where are these buyers now? Are they taking profits? Are they holding? Are they looking to cover?
Right. And so what the VWAP does is it kind of tells you what their position is.
Okay.
Yeah.
That makes
Right?
sense.
We can see here our moving average envelope. You're going to click on that and you're going to apply 1, 2, 3, 4, 5 of those. 1, 2, 3, 4, 5. Okay. So 5 moving average envelopes. And you're just going to click, and it'll apply a bunch of them. Okay. So that's pretty easy. Moving average envelope, you're going to add 5 of those, and then you're going to apply an exponential moving average or an EMA. So you could type in expo. So EXPO is going to pull up the exponential moving average, okay, right there. And so we're going to click on that exponential moving average as well. I'm clipping this so you can do it afterward. I know you're not going to be able to really do this live. So we've got our EMA. So we've got our 5 envelopes. We've got our 1 EMA. Now inside of those, they're going to look like this, okay? I got it all pre-saved here, so it's a little easier. So they're going to look like this. Our EMA, right? We're going to pull up our EMA first, our moving average exponential, or exponential moving average. Now this is going to be the 8-day EMA. The length is going to be 8. The color is going to be, well, I have it set to this darker blue, okay? And under price, this is really important. Under price, we want this to be set high plus low plus close divided by 3. So I'm going to just wait 1 minute. I want you guys to all do this. I'm going to mute and I'm going to let you all do this, okay? So go ahead and get that pulled up, all right? Zoom the recording. Those envelopes, we've got our EMA set up. Now we're going to go ahead and we're going to apply our inputs to our envelopes. So they're all going to be high plus low plus close divided by 3. So here under price H, price I, and average type, this is where we're going to have an exponential. Okay, make sure it's exponential, not simple, not weighted. These are all going to be moving average envelopes, and they're going to be exponential moving average envelopes. So that's important. And then under price H, again, high plus low plus close. So same as price I, high plus low plus close divided by 3. Make sure it's high plus, not the high plus low. 2, not the O plus H, right? There's a lot of options, so just make sure it's high plus low plus close divided by 3. That'll be standard for both of those prices, and then the average type is exponential. They're all going to look like that, okay? So those settings are going to be configured the same for all of them. And then under, okay, we'll open up our first one here. Our displacement is going to be 0. Our length, okay, this is going to be the first one, but
they're all going to have 8 as the length. So you can see, I know it's kind of hard to see, but the first number there after the displacement is going to be 8. So we've got our displace as 0, and then we've got our length as 8. So they're all going to be 8, and the only thing that's going to change on them is going to be the PCT above, PCT below. So our first one is going to be 0.181. Again, these are just fib numbers. So 0.181, 0.181. Okay? And then you can change this color to red. So this will be our band right here. Okay? Right outside of the first band, right outside of our 8-day EMA. So that's this band right here. So right here is going to be this red band right there. Okay? So 0.181. The next one is going to be our yellow or our green band. So one more outside of red. Okay? Color, just green. This is going to be 0.382. 0.382. Okay? It's the only thing you're changing is 0.382 for green. Then our next one is going to be 0.618. And that's going to be our yellow band. So our yellow band is going to be 0.618. Okay. And then our purple or pink, whatever you want to call this one. You can change these colors, by the way. You can make them whatever you want, or you can match mine. Okay. This band is going to be 0.809. 0.809. And then our last band here, it's just going to be 1. Okay. And that is going to be our outermost blue band is going to be 1. So blue, purple, yellow, green, red, dark blue. So that is the envelope system. Our mean is going to be the 8-day EMA. And then we've got our exponentials, high plus low plus close. They're all 8. And then we've got the fib numbers, okay, for each respected one. And I believe that is it. I believe those are all the settings. If yours doesn't look like mine, let me know. I'm going to clip this. And now you should see the envelope system. And you can change the candles if you want, the colors of the candles under settings, under appearance. To the ticks, you can make them white if you want, which I prefer. So now you should see what I see. And we're going to use this. Typically, we're going to use this on a 10-minute or a 5-minute time frame. So make sure to go ahead and add that time frame if you haven't yet. So it'll be an intraday, 10-minute, and we can do 5-day, 10-minute. Most of the time, we're going to use this on a 10-minute. Okay. So go ahead and just, there we go, 10-minute. Okay. So we could see here, we've got our envelope system set up on SPY, and we are ready to go. In this lesson, Chris talks about the psychology of the different market participants and how the subjective opinions of market participants move price. Before we start this lesson, I want to ask you, does a market crash occur from a market being oversold or overbought?
You talked about how where does a crash come from, or where does a run come from? And it doesn't come from an oversold or an overbought market.
Right. This is a cocktail conversation.
I don't know. I think that's
at a keg party or something, you guys, and you're like, do crashes occur from overbought or oversold?
Answer, like, do crashes occur from overbought or oversold?
Wait,
crash on the
right. Well, this is the same sort of thing, right? Like, if you think about it from just let's piece the actors together. It's like a play. We're going to piece the actors together. Imagine we're using reversion to the mean, right? And we're short, and we sold them up here, right? And now it's down here. We would want to buy them back.
Yeah.
Right. And so
that is, yeah, wow.
Right. But now, all right. So here in this down move, right? Like, all right. So you sold them here, right? Now you're like, okay, my objective is blue, right? So it gets to blue, and you're just a prudent participant in the markets, right? It's at blue. You sold this blue. You're like, thank you, right? Now, everybody who's short is like, okay, that's great trade. Congratulations. We had a good day. Now, who does that leave? If the shorts are, who's going to buy them? Because think about this. What's the direction of the market here? It's going down very quickly, right?
Yep. So it leaves the people who are long or trying to go long.
Right. It leaves the people who are long, and price is moving quickly, and the shorts have covered, so those buyers are gone. Anybody with a common sense in this case, you wouldn't want to rush in to help somebody who has a problem. Like these longs have a problem. The shorts have covered, right? Shorts have covered, and the people who are watching smartly are like, I'm not in any rush to take care of their problem, right?
Yeah,
so,
that makes sense.
Right? Like, because, and in the market, right, as time goes by and you have the wrong position, it gets worse. So what would be where would we start to see the impetus to buy? We would only start to see it when it was down here, right? When it was making lower lows, right? But it's losing momentum, right? A smaller band.
Yeah, that was a light bulb moment for me.
Right?
Yeah.
So all through here,
I get that.
the shorts have covered here, right? The shorts sold blue and they bought blue back. From here, these are just longs getting roasted all the way down to there.
Yeah, it's a lower low, but you can like visually see that the
So are we saying that people are trying to go long now, but the market's
No. It's you would say it's finding buyers, right?
Yeah.
We don't know if it's who or what they're doing, but it's finding buyers here.
Finding buyers, yeah, because it's
right. It's finding buyers.
Okay, that's a good way to put it. Yeah,
right, and so they're not in any real hurry. Yeah. You can see, right?
Yeah.
Everybody's so traumatized after the vertical move, right? And so it's that horizontal that we're talking about, right? Vertical leads to horizontal.
Yeah.
We know from here, right here, that's the market was balanced, which is right here. Okay, we knew that the market was balanced. We knew the market was balanced here, right? And you can see, right, it was balanced. And so crashes occur from oversold because the prudent shorts have covered. And that only leaves the value players. What's a value player? A value player is somebody who's buying something because they think it's cheap. Okay? But if I go to Canal Street here and there's those fake Vuitton bags on the street, and the guy's like, they're $20. And at Prada, they're $1,600, $3,000, who knows, right? And all the tourists buy them, and they're like, this is such a deal, right? And you go back the next day, and there's still those Vuitton bags. And how much are they? They're still $20, right? So they're not exactly cheap if they're still there for $20.
Yeah.
Right? There's still supply. So the idea is, in regards to value, is that what people think is cheap is purely subjective. In this case, people who were thinking this was cheap, there was plenty more supply. There were still bags on the street.
Okay, yep.
Right? So the mechanics around overbought and oversold are important to know, because as you become overbought or overextended to the upside and or oversold or overextended to the downside, is that even the people who thought they were cheap are starting to worry if they're wrong.
Yeah. No, I mean, that was also, it makes sense. Like,
right? And so for our great cocktail party question is like, do crashes occur from overbought or oversold? And the answer is oversold. And people go, why? And you say, because the prudent shorts have covered. Who does that leave? That leaves the people who bought them because it's cheap. Well, some bad news happens or something happens. And who are they going to sell it to? More people who think it's cheap? No one's going to rush in to buy their problem.
Oh, okay. Yeah, there we go. That makes, because now they have to go even lower.
Right, they got to go lower.
Yeah.
Well, how's this? They need more time to go by to find people, and while time's going by, the price is dropping.
Yep. And they gotta give you, and then just pushing and pushing the price lower.
Yeah.
Right, like people aren't lining up to be like, oh, I'll take this problem off your hand.
Yeah, because the natural response is, oh, a crash occurs from overbought because it's overextended.
Right.
And then it's going to revert back to the mean, right? Because if it's overextended, it's going to cause a crash. But in reality, it's, okay, so Chris, if you want to explain what happens when a market is instead of oversold, overbought, who does that leave?
That leaves people who are short, all the prudent longs,
Yeah.
people who are, right? There's this really old guy who was like in his late 80s or early 90s who traded on the floor in the internet melt-up. In 98 and 99, the NASDAQ doubled year over year. That would make the Dow at like 120,000 in 2 years. And I asked him, I said, would you have caught this move? And he said, no. And I said, why? And he said, because prudence dictates exiting a winning position long before the highs, which dovetails into this conversation about if the market's overbought and you're long, if you're a prudent person, similar to, remember we were talking about, here, look, if you bought the blue here, you sold the blue here.
Mm-hmm.
Right? You see that?
Yeah.
So that's a prudent trading decision.
Yeah.
Right? Trees don't grow to the sky. Not every story has a happy ending. There isn't a drug for every disease. Not all marriages last forever, right? Prudence dictates exiting a winning position long before the high or low, depending on your position, right? And that was this 90-year-old guy 20-something years ago told me that.
Wow.
Isn't that smart?
Yeah.
Interesting. Again, and that just kind of ties in the greater philosophy of trading, right?
Right.
Where are you taking profits? Where are you cutting losses?
Right. The idea is that we want to be able to come back tomorrow. And remember, too, slow positive cash flow is really important for your own mental health in regards to approaching this thing every day.
Yeah, small wins over big wins, I always like to say.
Remember, change that occurs slowly is more permanent than change that occurs quickly. Like mistrust, a big gain. You see all these people who win the lotto and their lives get destroyed.
Yeah.
Right?
That's a good example.
Right? Like this is a job. This is, right? Like we treat it like a job.
Yeah.
And so it's a career.
Yep.
And now you guys are going to be the stewards of all this knowledge.
All right, guys. Well, that'll do it for today's lesson. We went over how to find a balance move in reversion to the mean. This is a tool that every trader should have in their toolbox. We all believe that. This is part of the journey. We're really excited to be going over next episode, how to detect, find, and use a vertical move in your trading. This is just a start. And Chris, it's such a pleasure to be working with you. I had a great time today. I hope you guys watching had a great time today. And this is just the beginning.
Yep. Next week should be great. Talk to everybody later. Thanks for coming.
Awesome. Welcome to lesson 3. Now, as we've established, the market moves from horizontal to vertical. So once we know that the market is balanced, we want to be able to act on the vertical move. In this lesson, we talk about the hints and participant psychology behind closing off a direction. One of the most valuable things I learned from this lesson was the true definition of a high or a low. Welcome back to lesson number 3. We're here with Chris. Chris, it was nice to meet you. We were just in New York.
Yeah, we were.
For the week. We went out to dinner, traded with you at your office.
And, we made the mistake of not rolling the cameras while we were trading. We'll have to do that the next time. That was really good.
Yeah, I'm
sure people would have loved that, right? Like, hey, what do you think about this? Well, yeah, I like that, and don't forget to do this.
Yeah.
Good point.
Yeah. How'd we do, Chris? We made some money, right?
Yeah, you did very well.
Thank you.
I thought,
appreciate it.
And I've never said that I would trade next to anybody, but I would trade next to you guys.
Thank you. Appreciate it. Same goes for you.
Yeah,
That was awesome.
Yeah, I mean, for real, you were legit good. I was like, how,
Thank you.
That's good.
Appreciate it.
For everybody who's watching this, I can vouch for these guys being legit good under the pressure of real time. Not like, maybe this or maybe that, but like do this, do that.
Mm-hmm. Appreciate it. Yeah, it's all about that confidence when you click the mouse.
Being able to be right or wrong and understanding that we have some chance in both.
And knowing when you're wrong, right?
No, we weren't wrong much, I don't think.
Yeah, well, no, like when you trade, it's like a skill to know when you're wrong and then be confident saying, okay, I'm wrong, and then acting on that.
Yeah, I always say to practice with your friends. Just say, if something comes up, be the first to be like, oh, well, hey, I was wrong.
Yeah. Trading. Hey, well, anyways, maybe we'll talk about that in more trading psychology as we move on. But today is episode 3, and we've gone over mean reversion strategies and then how to detect when a market is balanced. So today is appropriate that we go over how do we capitalize off of the market exiting a balanced position. As we know, markets go from balanced to vertical. So let's start it off, Chris, if you want to take it.
Couple things, right? First, I want to show you my screen. You guys need to enable my screen. But for people who are just tuning in, the market spends 85% of its time in a reversion to the mean. Sort of if you were sitting at the beach, the tide comes in, the tide goes out, the tide comes in, the tide goes out, sun comes up, sun goes down, sort of a back and forth. If we're spending 85% of the time going back and forth, there's the bulk of the big sort of elephant game, the metaphor of like hunting for elephants, big game hunting is taking down that vertical move, right? Like landing the big fish. And kind of reversion to the mean is kind of like factory work. It's dependable. You're chipping away. It's not the big glory. I bought it at 5 and now it's 10 in 2 hours. And so what we want to do is tell our students, the people out there, the signs that we're going to go through, like sort of a checklist of what would define the market being ready to go vertical. And so the first thing that would be is the market needs to close off a direction. How do you guys think a direction could be closed off?
Tail.
That genius right there. Tail is perfect.
Yeah, price moving fast, kind of certainty, right? I mean, as you see on 12/8, where was that? It's kind of, what day was that big drop when?
I think
that was CPI right there.
Yeah, CPI.
Right here. You can see it right here.
I mean, we're just looking for a market to be balanced. When the market finds balance.
Right. And so, right. So if the market's balanced, then we're looking for it to kind of tip its hand, like to lay some cards on the table so that we can say, oh, it's not going to go that way. So by default, it's got to, thank God this only has 2 ways to go.
Yeah.
Right. And there's 0% chance of a retracement, right, from a balanced position.
Well, yes. And so why do you think that would be, right? Because if we're balanced, everybody is like, okay, this is fair. This is a fair price. We have all got what we need, right? So then all of a sudden, it's like someone yelling fire in a theater, right? Everybody is either trying to get out of the theater, or in the case of the market, they're trying and say it's going up from a balanced position. Everybody's trying to buy it. And everybody who's short is trying to cover. And because the market's starting to move from a balanced position, everybody wants to get on board. It's like the hot new viral trend is happening right then, right there. And so that's when you're going to get the most horsepower and the fewest number of participants that will take the other side of the trade. They'll be overwhelmed as people say, well, something's happening, right? Or the other way, if you have a problem, like you're the wrong way and you need to get out, there's not going to be anybody in a rush to help you get out. Everybody's going to be trying to go the way the market's going. So, right, we're talking about the signs, right? What would be the signs that the market's would be ready to go vertical? Well, the first is, of course, we've established that you need to be balanced. Then the second is that it's going to try and close off a direction. And so far we've said, what is it? It's a tail, right? Or you start to see the market move with 0 retracement, right? That's also, like you're saying, it could be all the king's horses and all the king's men kind of thing. And you could see here today, we were talking about today, by the way, this is a 30-minute chart. The moving averages are 65 and 33. And we just use that as a quick and dirty way to establish balance. So when the lines come together, that says that the market is balanced. So today was a good example of all the king's horses and all the king's men tried to lift this thing up. They used all their horsepower up there, and it really didn't go. You can see it tried 1, 2, 3, 4 times. So you called that person, they never called you back. You're trying everything you can. to get it to go, and it doesn't go. That would be the market saying to us that it's closing off a direction and the market's balanced. That means it's going to go the other way. And you can see it went vertically down from that position. And so the market's balanced. We're looking for a vertical position. We want it to close off a direction. So that would mean it could spike up and then spike right back down. That would be the certainty that we're looking for of what's the definition of a high. So many people want to sell it that it moves away from there quickly. That's the certainty, right? That's closing off a direction. In the case of today, the market goes up, and it's like all the king's horses and all the king's men. And you can see in these prior highs, though, while the market was not balanced, you see those prior highs where the market seems to run into a wall of sellers, of supply. And that seems to be, I mean, nothing is hard and fast, but it seems to be the pattern that tops are these sort of rounding supply sort of things where you just can't get through the supply, and then the market tails off. And bottoms tend to be these phoenix things where the price is so cheap everybody wants to buy them. And I'm wondering if, like we were talking about when you guys were here, is that we were all trained to be such good consumers and buyers, right? We know to buy the air conditioner as cheap as possible, but when we sell things, it's just like the car sits in the driveway till we call that guy and we tell him we'll sell it to the price for him for whatever the price is. In other words, human beings are trained to be better buyers than sellers. Anyhow, the point is that we're looking for something that clues us into a direction being closed off.
Yep.
Right?
Yeah.
So direction being closed off could be done with an RSI divergence. The market makes a lower low, but the RSI is not as low as it was, right? In the case of the stock market, it could be an internals divergence, right? The market makes a lower low, but the advanced decline line does not, right? Something like that. Anyhow, the understanding is that the market closes off a direction. It sounds so strange to people who are new at this, but we're looking for certainty, and it seems like such a strange currency to transact in. Is what is certainty? And in a world where the pricing and everything is so uncertain, but you have to take my word on that. That's the currency that the market transacts in, and it actually puts a huge premium on certainty. And so in your travels and your exploration and solving the puzzle of the market, make sure that you focus on the fact that the market's looking for certainty. That was a term Peter Stottlemyre used, the creator of market profile. Okay, and I always thought that what's certainty? Why is certainty important? And who decided, like all of a sudden, who was the sheriff that decided certainty was important? But
well, when I think of certainty, I think of it's being decisive. So when you see price action find a level and move away quickly, or when compared to when you see it move around a price level and it's moving up and down below, kind of acting like a mean, that is uncertainty to me. It doesn't know where price wants to go, while moving away from price fastly shows quickly is indicative of a bottom, in the sense that, like you said, when something's cheap, people are going to buy it fast. And when something is oversold, people are going to sell it fast. So it's not going to stick around for a while.
Right. When it's expensive, people sell it and quickly. And when it's, it's an interesting conversation, right? Like, what's cheap? You take someone to the restaurant and you're like, look, there's free Brussels sprouts. And they're like, I hate Brussels sprouts. And they don't want Brussels sprouts. But it's like there's a collective participation in the market that is cheapness, quote, cheapness or quote, expensive is subjective, and it's defined by the collective. And that price behavior is that tail that we're talking about, that as you say, right? Like the price will move away from there quickly, either if it's too expensive or too cheap, defined subjectively by the collective in the moment.
Yeah.
Right? Defined subjectively by the collective in the moment is the way that we determine certainty. You're exactly right. What else? It's like the biggest, fastest, strongest move usually has something going for it. Right, versus, like you're saying, if it's just chopping around, that's sort of a collective ambivalence.
Can you find some examples on the chart of where we saw certainty in price?
Yeah, sure. Like, this is a 30-minute chart, right? And so any place that we see a tail exhibited here, you could say that would be certainty, right? You see tails here. Yep. You see beautiful tails on the low, right? tails. There are many people who consider railroad tracks, where you have it up and down like that, to be certainty. And the flip side would be, if we move the chart back here, this chopping around.
Yeah, uncertainty.
On uncertainty, right? And then you see the lines come together and the market getting balanced. And this was, people knew, right, that the scheduled release of the CPI was this Friday. And so this includes both day and night. So you can see, right, it goes up, makes a new high, comes down, makes a new low, and then sits and chops around, right? And kind of that is very uncertain. Now this is a giant tail.
Yeah.
Right? A giant tail. And so this here was the third largest move in history.
Okay, that was when we were there with you last week when that played out, right?
Right.
I think it was the
no, that was the week before.
yeah, we were just talking about it because
this was
monstrous
before.
Right.
move. It was pretty crazy.
Right. And then game theory says that the first retracement functions as support because these people who bought here had the least amount of information. And so now, as more time has gone by and these people have been proven right who bought at this first dip, the game theory says that this number it's like just a shade under the figure 3,600, should function as support. So on the odd event we get back there, we'll see if that happens. And of course, people in the future who are watching this, today is October 20th. And so that occurred, looks like a week ago on the 13th of October. All right, so we're back to like closing off a direction, right? If you're chopping around and the market's balanced, we're chopping around from, say, we'll draw here to here. We're just chopping around, and we're looking for it to close off a direction. And you can see that because it's visiting these highs right here, and it's visiting these lows many times, right? That is, in a sense, right? Remember, if there's a collective ambivalence, right? If something's cheap, so many people want to buy it that it moves away from there. So the corollary to that is if it goes there a second time, it's maybe not an opportunity. Does that make sense?
Yeah.
So it's just trading in this range, and we're looking to break out of it, essentially.
Right. Or in trading, you better be really careful if you're taking a second chance.
True.
Right? Because the definition of a high or a definition of a low with certainty attached to it is that the price moves away from there and never comes back. So the optimum entry is like a finger snap, right? You buy it and it moves away from there and it never comes back, right? If you buy it and it comes back, all of a sudden, maybe people aren't so certain that that's the low, or right? So the certainty is easily defined by the price moving away from there and not returning to there. See, for example, this low that we're looking at here, the fact that we've been there so many times means that there's no certainty.
Okay.
No certainty in regards to
whether that's cheap. In other words, you've had a chance to buy them there more.
Okay, I see what you mean.
Right? You had, because, right, if the price was really cheap, it would have never gone back there.
Yeah.
Right? What do they say about dating? A quality person is usually off the market.
Exactly. Yeah.
Right.
It's like uncertainty in the value of what people are getting.
Right. And right. Like, exactly right. The understanding is that if you get a second chance, not everybody agrees with you that that's cheap. And in this case, if you had, it looks like 1, 2, 3, 4, 5 chances at that level. And then you see when the news came out, it didn't even stop. It went right through that.
Yeah.
Right here, right?
Yeah.
Paid zero respect to that because it had no certainty.
Okay.
Be like, it's going to be like a knife through butter because there's no tail there. Right? Because there's no tail. Look, it's like 1, 2, 3, 4, 5, 6, 7, 8 times it stopped there. So even here on the third time, these people were definitely, like Clint Eastwood, feeling lucky punk. They were taking risks that they maybe didn't understand. So yeah, that's an important distinction, right? Like support should not be multiple tests of the same level. given our definition of certainty.
Yeah, I was gonna say that's like opposite of I feel like how
Right?
most people
Yeah.
think.
Right.
The way
Like
I
people
think
are
about
like,
it.
oh, but look, here's a CPI number. We'll buy them because everybody bought them there before. No.
Yeah. Okay. Wow.
Okay, so you're saying the 350 level is going to act as a stronger support than the 359 level.
I'm saying that here in the future, okay, now this cleaned out, this reset the whole bar.
Yeah.
Right. This is the beginning. Now you have this third biggest move in history. Right. Up it goes. Then the ensuing drop. That this low, these people acted with no reference points. Okay, because they had no reference point. This move gets rid of everything behind it.
Yeah.
As being relevant, because you clean out, there's no more orders left after you go here and here, right? So these people who bought this should function as support, because in game theory it would be because these people acted with the least amount of information at the time, no reference points, and they were right. Okay. And then you see, because the market's so disjointed, it tries to get balanced here with the lines, tries to flatten out, but we're in such a vertical environment, up they go. Right. And then, and now you can see it got balanced right here, and they couldn't even get going again to the upside. So
the more we talk, I kind of realize how the market is like a book, and you're able to read it and understand what it's telling you. And I think this is kind of like our goal with these lessons is to, especially with you, is to help people read the book, because there's so many strategies and there's so many ways to trade, vehicles to trade, but unless you can actually understand and read the market, it's all kind of meaningless.
Yeah, isn't it fun? Like you can explain to someone across the dinner table what a low or what a high is. Just right. Well, and you can do it in any which way. I went to the store and they had something on sale, and by the time I got there, it was all gone. A concert comes out and the tickets are priced too cheap. The tickets are sold out faster than you can get them. Right. And so you can explain to people, the idea of if the price of something is too low, it's gone. And the price of something is too high, nobody wants it. Okay. And then look at the chart and you can say, oh, okay. And then we decided that because of that, we're going to attach the meaning of certainty to that.
Yeah.
Right. And because of that, then we just learned what the definition of support is.
Yeah. Makes sense, because that's established where people think it's cheap or where price is a fair value.
Right.
I just want to take a second to interrupt this episode. I hope you guys are learning stuff so far, but I do want to give you an opportunity. Now, I'm going to be trading every single morning. I'm going to be live. You're going to be able to sit and watch me enter and exit positions, executing the system that you're learning now. If that is of interest, I'll put a link in the description below.
In this lesson, we look at the characteristics of a trending market and further analyze charts with Chris.
Okay, so now that we've kind of touched on, what is a support level, resistant, balanced, how do we play that? How do we use that knowledge inside of our trading outside of, here's this, because there's 0% of a retracement, right? As you see, when the CPI came out and it moved through that kind of balanced area, it didn't retrace at all.
Or even today, look at today, when it came off the highs, there was no retracement.
So in a sense, like from a more technical standpoint of how you enter the trade and where you're putting your stop, how are you doing that?
Well, if we know that the market is balanced, and we have many ways to measure that, right? You can do it through Bollinger Bands or lines together on a moving average as they converge. Let's do no harm, like the doctors, right? We say, if you got caught long today, say you were buying up here and expecting the market to continue higher, and the lines are together, so you know that the market's closed off a direction, you do not average down. Yeah. Right. First thing you do is that if the lines are together and you're wrong, you should get out, because if the market doesn't do what you think it's going to do with the lines together, it's going to do the opposite. And because there's no chance of a retracement, because the lines are together, it's just like you stand no chance. You should actually reverse. right? And so with the lines together, your stop becomes a time stop. As soon as you have a position on and it's wrong, you're gone. And if the lines are together and you're wrong, you don't average.
Yeah. Do you want to explain what that means for a beginner? What averaging means?
When I first started on the exchange floor, they were always saying how it killed more people than anything in the world was, you buy a stock at 10, it goes to 9. You're like, it's cheap. You buy more at 9. Then it goes to 8. You're like, wow, I can't believe it's so cheap. And you buy more. And then the next day it's 7. You're like, I'm going all in. It's so cheap. And then the next day you wake up and it's trading 4. And the size of your loss is so great. And Mark Douglas, he wrote the book Trading in the Zone, or The Emotional Trader. He's a good author. Those are good books. Called that the forced awareness moment. And in trading, we definitely want to avoid forced awareness moments. Right? So by understanding where we are in regards to if the market's balanced or not, we understand that when the markets are balanced, you never, ever, 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 ever average down.
Okay. Yeah, because I was going to say, it's not like you don't want to average down. Like, that's a huge part of, like, most traders' strategies.
In a reversion style program.
Yeah.
Right? Which is 85% of the time.
Yeah.
But you'll get blown out if you average when the market's balanced.
Yeah.
The obvious question is how big is the vertical move? And the only person who knows that is the person with the biggest order. But you do know that it's going to go vertical because it's balanced, right? And you know that by default, if the market's balanced, it can go vertical. It doesn't have to go vertical because a balanced market can stay balanced.
Yep.
Right.
By default.
Right, like a balanced market, you can be balancing on a bongo board, right? And you can stand there and eat dinner on it. You can stay balanced forever, right? And then it's only until somebody comes and knocks you. That's what essentially is happening, is that an order comes and knocks you off the bongo board.
Got it. Okay.
All right.
Do we want to pull up another chart and?
Yeah. Well, you guys want to pick a name of some sort, or what are you trading? The diamonds?
Yeah, you can do.
What did you trade today?
XLU.
XLU. All right. I'm not sure. I don't think I get that, but let me try.
Yeah, I did. It didn't. It's the utility sector.
Yeah, I don't have that.
Let me give you another one. That's okay. Look at VGK.
Okay.
VGK I traded 2 weeks ago, and I made like 40%.
VGK.
Shorting.
What is it?
VGK.
Is Viking Energy? Oh, here it is.
Yeah. That's it.
Yeah, I wonder why it's taking so long. That's so weird. That's very strange. Let's see.
Well, pull up like
Hold on.
Snapchat. Simple one.
Okay. Oh yeah, didn't Snap have a
Yeah, it's like a Snapchat.
Snap go?
I think it's. I haven't looked at Snapchat in a while.
It had earnings today.
Did it?
Yeah.
Okay.
Interesting.
Let's just go here. We'll flip out and come back since it's having such a hard time. Stock.snp. Empty session information.
Weird.
That's so weird.
Let's look at Apple.
Right?
You gotta have Apple.
Right? Jesus. Sorry.
In this lesson, we look at the characteristics of a trending market and further analyze charts with Chris.
Oh, look, the lines are together, you guys. Isn't that interesting?
What are we on, 30 minute?
Yeah. For people who are watching again, it's a 30-minute chart. And the lines are 65 and 33 period moving average, exponential moving averages. And we didn't make those up. We did a study for a couple of years on allowing the market to cycle between vertical and horizontal. And it came out to be around 130 to 140 half-hour periods in that. So I needed a quick and dirty way to represent balance after the trade centers came down. This is what I used, and it seemed to work pretty well. Yeah, you guys look, right? See the lines go, look everywhere the lines go flat.
Yep.
Mm-hmm. Right?
So
now, it's not a crossover system.
Yeah, I was going to say.
Not a crossover, right? Let's scrunch up the chart a bit. And so, all right, so Trending market is when, right, you see the moving averages apart and moving in a direction, right? You can see them how the moving averages are moving down and the market's underneath them. That would be a trending market.
Yeah.
It's interesting how the market uses it as a roof and continues down. Then you see the market trying to get balanced, tries to get balanced, fails, right? Again, tries to get balanced and fails.
Mm-hmm.
Here's a great classic example right here, right? The lines are flat. See the tail at the high?
Yep.
Mm-hmm.
What is the tail? So many people want to sell it, right?
Mm-hmm.
Down she goes,
There you go.
right? Look, they get balanced again with the tail at the top. Down they go. Oh, look, tail at the low. Market got balanced, broke up. Okay, it seems like it's getting balanced here too. It'll be interesting to see if it holds.
Yeah. Will be
Isn't that cool?
interesting.
What's the oscillator you have on the bottom there?
That was created by Stan Yabroff over at CQG when I explained to him what this was. And he said, well, why don't we build you an indicator that shows you how far apart the moving averages are?
Okay.
And when the moving averages get far apart, his logic was, and he's using this, defining sort of green line is 300 bars back. When the moving averages get further apart than in the last 300 half-hour periods, he was like, the market should be ready to get balanced. And see how it goes right now.
Because the market wants to be balanced, correct?
Right. It's seeking balance.
So when you see that extreme separation of unbalance, it's a sign that, okay, now we should be looking to move in the direction that would make the market balanced.
Correct. Or you're pushing your luck if you're looking for further imbalance at that point.
Okay. That makes sense.
Right. Isn't that interesting?
Mm-hmm.
You see here, it's like, oh, it was due for an up spike here, right? It was like it had been a long time since the moving averages had spun to the upside.
Mm-hmm.
And so as this comes down, then all of a sudden you see that the Apple started trading higher. So here, this was a pretty good, decent understanding of the market's going to get balanced. And see here, the market makes a lower low, but see how the moving averages aren't as far apart?
Yeah.
So you could argue that there's less momentum
Yeah.
Okay.
here,
Yeah.
right?
Makes sense.
Less momentum because the moving averages haven't had a chance to get pulled apart.
Yeah.
And then up they go.
Okay,
So-
because the difference or the width of the separation of the two moving averages represents how fast the market is moving in a direction. So therefore, the further apart it is, the more aggressive momentum behind the move.
Right. And then the indicator with the down here says, well, you know, you're at the end of the rope.
Yep.
And then here they're saying, no, you're either it's going to zero or it's a hell of a buy. Art Cashin used to say it's a bad bet to bet on the end of the world because it only happens once.
Mm-hmm. Yeah, and then if it's the end of the world, screw your money.
Right. Right. So at a certain point, you know, when the fear is running hot and deep, you guys just make sure that, you know, you go for a walk and be like, all right, what do we want to buy?
Mm-hmm.
Kind of thing.
Mm-hmm.
And then, of course, right, you're not averaging down into those. So that means what? Your first entry is your best.
Mm-hmm.
Yeah.
Right?
Yep. And if you're wrong, get out.
Right. Or if you're wrong, you can't add.
Mm-hmm.
Right? Because in this case, we're looking for a reversion to the mean. Right? Because the lines are apart and we're looking for them to come back. But, you know, we're not perfect. So we just don't add when we're uncertain. Let's look at crude oil. Crude oil's a gnarly. It's like Mad River, right? There's no grooming. And so you can see mostly tails, right? See the tails everywhere?
Mm-hmm.
So if you're trying to buy a bottom, you want to make sure that price goes your way quickly, right? If you're stabbing at buying them, right? And you're like, okay, I think this is a bottom. You're buying them. You see the way the price moves away from there quickly?
Mm-hmm.
See that? Right? The true definition of a low. And do you see here when it makes a lot of bottoms, how it doesn't really respect it and then crashes? But you see how this one actually held it for a bit, right? And then when it broke it and it didn't go anywhere, no longer valid.
Can you use like certainty as like explain how that would play out? Like considering how it was trading right there. I wish I could put my mouse on the screen.
Yeah. Here is where we're talking about.
So what would be certainty?
the fact that it immediately reverses, they call this, the old guys on the floor used to call these railroad tracks, the two lines right next to each other.
Okay.
Right, that they call that railroad tracks, down and then straight back up. And you see then these lows, see how this first low right here and the second low respected that to the tick.
Yeah.
Right, because these guys are acting with the least amount of information, and it worked. It went up from there. So, and then see how it held, and then how it shot up again.
Yep.
So the understanding is if you think, let's pick some place where it didn't really work so well, like here, right? You think, okay, look, it comes down, you buy them here and you're right, but you see how then it keeps testing.
Yeah.
It's not really going anywhere. That behavior, and then eventually it just, goes nowhere and then crashes through there. But if you look at today, that same behavior is equivalent to right here, where it's not really going, and then it crashes through these levels, right? This is not certainty.
Yep.
Right? And so in a sense, we could say that the bulls have a problem here today, even because no certainty, and no certainty here. Right? And the bears are certainly winning because they have these spike highs that are sticking.
Yeah, looking on a larger time.
Right?
View.
So here we are, us three guys were out in the jungle hunting for certainty. And so we've, look, I see certainty on the highs. And do we see certainty on the lows?
No.
Not really. Right? We see sort of a collective ambivalence around the lows. All right, so now we've got certainty in the can.
Yeah.
Okay. And so and we know that from a balanced position, we close off a direction using certainty, that it's going to go the other way. Now, how long does it go that way? Well, it goes that way until the person with the biggest order is done. It goes that way till we get a tail going in the other direction. It goes that way until so many people get involved in the trade that we start to get retracements. Right? Inevitably as a trend ages in time, it draws in enough participants that you start to get the chopping back and forth. Does that make sense? Yeah. Inevitably as a trend ages in time, you get people who are less good entries, they're later in the move, as well as the people who've been in the move for a long time. Right? And so those people who are in the move for a long time are maybe being prudent and taking profits. That would cause a retracement, right?
Yeah, I was actually going to say that.
Cool.
I just want to make sure everyone who's watching can follow along here. Your moving averages, are they SMAs or EMAs?
I use EMAs. A lot of people use simple. That's what I've stuck with. I don't even know the difference in the calculation. I think they weight the future or the present more than the past.
Yeah, and are they open and close average, or they?
Yeah, I just use the high-low close divided by 3. I believe here. Let's look.
Yeah,
let's look. We can just go to modify all parameters. High-low close divided by 3.
Okay. Well, there you go, guys.
Straightforward.
You want to open it? All right. Yeah. So now
that's great.
So we've talked about a direction and finding the bottom and the top and how to detect that and how you can use that to kind of find direction in the market. But what about following the trend? So you kind of see that we have the CPI shoots up, goes back down, kind of finds that support level, and then it goes into like this bull flag almost. How do you trade with that direction? Because that's balance, right? The market is going into a tighter range, as we discussed in the first episode.
Right.
So how do you play that type of balance in the trend following?
Okay, so all right, let's just go through the hypothetical situation, right? Or the priorities associated with getting a trade on. First, decide whether you're in a reversion to the mean reversion to the mean segment, or a potential vertical move is about to unfold. Then you decide, okay, the market's balanced through whatever methods that you've chosen. Then you start to look for certainty. You see the certainty, it tips its hand. Remember, it's going to be quick, right? By nature, right? Remember, we're looking for certainty. By nature of that, it's quick. Then you get the trade on and you're right. Okay. And then the idea is just to let it bake. That's the hard part, is let it bake. And then, so then you're asking, okay, how do we define, great question. How do we define where we are and what to do from that point? So we're going to look at first of all, the background would be if say in this case, today you sold them. The background of the market is up or down, gents. Which way are the longer term moving average is pointed now?
Down.
Down, yeah.
Down, right? So given that you're trading with the trend, you would have to be a little bit more patient than if you're trading against the trend.
Okay.
Right? And in fact, today, right, you see that the market tried to go up first, and that was against the trend. So then if we're going to trade against the trend, we have to be quick. And if we're trading with the trend, we have to be patient. Okay?
Interesting.
So looking at where we are right now, on this chart, what would you expect or not expect? We're not making any predictions.
But how would you play out?
How would you?
What are you looking for?
Yeah, there you go. What would you expect? You would expect you're looking for, as today demonstrated, since any up move is going to be shorter in duration than because of the trend being down. All the moving averages are down.
Mm-hmm.
We're lower over time. We're lower on the year. What are our expectations? Our expectations would be that it would, for the trend to reverse, we would have to get it to go up and stick higher.
Yep. A break of
Right?
that pattern of like the lower highs.
Right.
Put simply,
Right?
yeah.
Right. Or as Hawkins would say, you need to have shorts trapped.
Yeah. Okay.
Right? Like what happened in that CPI, right? It was a bad CPI. We went down 100 handles and then we rocketed up.
Yeah, people went short.
Right? People are caught there,
Yeah.
right?
Mm-hmm.
So to everybody watching at a later date, the idea is that the market went somewhere and then people got involved and then were dramatically proven wrong quickly and did not have the time to get out. And so those kind of situations are very predictable when people are caught the wrong way. People who aren't, well, how will we say it? People who aren't getting what they need,
Yeah.
right? People who aren't getting what they need are completely predictable. So yeah, so the idea is that maybe that's the idea of how certainty works around a balanced position. There are people caught because of that, like to this morning, right? It went up, everybody expected the breakout, and then it just went straight down. There was no rebound, no retrace, no nothing.
Mm-hmm.
And so in that just made it super predictable that all the people bought them this morning had to sell them.
Mm-hmm.
Yeah.
And now the trend aspect. So one of the great black arts of trading is the understanding that trend following, you have to build intolerance. In other words, you say, in this case, you're short and it was going down. How much of a retracement can you tolerate for, to stay in the trade?
Mm-hmm.
Because if you make your tolerances for retracements too small, you get stopped out early in the move. But if you make your retracements too big, then you risk giving it all back.
Yeah.
Mm-hmm.
That's an open question, and to anybody watching at a later date, that's the black art of trend following systems, is how much tolerance you want to build into those systems. And then Pete Stottlemyre would always say, you don't know, to our question about like how are we reading the trend and what are we doing, you don't know till you're in it. Like it's as though you have to understand that we're going to read it as it's unfolding in front of us. I guess it must be like poker players who read the table in a flop or something. I don't play much, but the odds are constantly changing as the game unfolds.
Mm-hmm.
Right? And then you remember we're thinking like, okay, well, are they stretched? For example, we were looking at that indicator in regards to the moving averages being stretched. How many people were trapped the wrong way? Is the market speeding up or slowing down through time? Right? Are you getting more or less likes on that Instagram post?
Yeah.
Right? It's the speed of something through time.
Mm-hmm.
That's the critical metric. And then, of course, we talked about this when you guys were here, right? Prudence dictates exiting a winning position long before the highs. trees don't grow to the sky. Not every story has a happy ending, right? You can't expect it to go further than what would be a normal move. Say if the normal range for the day is $4 in a name, and you get the $4 or $5, you take your profits and you're like, thank you very much. It's a job, right? Like the whole idea of being right or wrong, we'll say for the ski slope.
Understanding yourself is just as important as understanding the markets. In this lesson, we talk about common mistakes and strategies you can implement to improve as a trader. Do you have any advice on, not being greedy? Because people get greedy and they'll end up holding. They'll go against their plans. They'll go against the indicators they use. And that's what would your advice be? You guys are just as smart as I am. What would your advice be to people who are greedy? I know I'm more happy with like a small profit than the chance of a bigger loss and just taking the small wins. And like I was talking with my dad, and he follows the trades I make, and he told me, he's like, oh, that trade you called out last week, the contracts are up like 150%. But he's like, it's good you took 35% on them, because at the end of the day, you have to have a system that you have to follow. You have to have your rules that you follow and a set plan. And if you go against that plan, you can never go against that plan. That's the thing. You have to be disciplined and you have to follow your rules. Because once you break your rules, then, it might be a small loss once, but you're going to develop the wrong habits. And it's all about forming good habits when it comes to trading and being able to have a system that you stick to. And
greed is a hell of a mistress.
Yeah. Does that make sense?
Greed, makes sense. The discipline before love in raising children, I think, is a wonderful sort of way to go about it. And I think that trading with discipline is the only way. If you're not using discipline, then you're just a dead gunslinger.
Yeah,
eventually.
I think one thing that I actually implemented in my trading when I first started was I started trading for the money. I think that's why most people start trading, right? And wanting to trade for money is, in a sense, greed. So I think something you can do tomorrow, when you guys watching when the market opens, if you struggle with this and you're not following your plans and you struggle to have structure in your trading, is size down your positions to an amount that the losses and wins will be so minuscule that it's not even about the money. It's about actually putting on a good trade. And once you do that enough and you trade with such small amounts that you're not even thinking about the money, you're just thinking about the trade, then you're programmed to say, okay, now I can size up, and you're able to look at the trade and these plays from a standpoint of how you're actually trading and following a system.
Pow, drop the mic.
That was good.
Right there. Everybody listen to that. I'm so proud of you guys. That's so good.
Thank you.
And so greed, guys, it's worse than the best drugs, probably, or the best mistress, or the best powder even, right? It's like, when you're skiing POW, don't you want to just keep, you want the slope to go forever.
Yeah.
You don't want to go up the chairlift.
Right. So so if you recognize in a trade that you're suffering from, I want the snow to go on forever, or I want this trade to go on forever, just consider that a warning sign.
Yeah. Or like hope in a trade. We made a joke before this episode. We were like, "Oh, I hope the market does this," because that's not a way to trade. There was a joke, because when you said hope, we all laughed. Because if you are trading with hope, you're not going to make money.
Well, no, you can. You can be lucky.
Yeah. Okay. I'm in the long run, may I put it.
Right. Oh, yeah. No question. On an individual case by case basis, you can put a trade on and hope with the probability going your way and for a structured reason. But any psychiatrist would say that hope is the worst drug the human beings ever invented.
Yeah.
And for trading, it's not a strategy. It's so not a strategy.
Yeah, it's all
love the way you guys are touching on the fact that structure.
Yeah, this is good. It's all about knowing yourself. Like, it's not.
Yep.
It's about knowing yourself, knowing the market. I think there's obviously so many different things that go into this, and you have to be. You can't slack in one way or another.
So what do we think? We need an understanding of the structure behind, like we were talking about.
Yeah.
We need an understanding of the process, for example, tails, and understanding that true opportunity exists for a finger snap, right? If you're going to buy the low, it better not stay there.
Yeah.
Right? It better move your way. So there's that structure, then there's the process, and then we're talking about the mental process of how we're going to think about what happens as a trade unfolds, right? We're going to just use what we can as clues as it's speeding up or slowing down through time. The tolerance associated with stops.
Yeah.
Right. And then the inevitable mental sort of gymnastics that is common for everybody watching this. You have to understand that the process that you will experience as you go through this learning curve is not particular to you. It's in fact, this is why trading works, is because this process is universal. So first you have to go through it yourself, and then you have to learn to recognize it in yourself, and then you have to see through it and then trade around that and understand. And then eventually we learn that people who aren't in step with that process, those are the people that are trapped, and that we act because we know that those people are trapped.
Interesting. Well, hey, I think on that note, that was a good place to end
It was a great
today's lesson episode.
Yeah, it's a really good lesson, you guys. And so, again, remember when you're trading for these vertical moves, they only happen 15% of the time, and it's not easy.
Yeah,
it's not easy, but we're here to help.
Yeah, for sure. And you guys are the keepers of the knowledge, and you are helping. So that's great.
Thank you. Well, everyone, thank you for watching. And
thank you, Chris.
Thank you, Chris.
And I'll see you guys next time.
All right.
Okay, see you guys in the next one.
Sounds good.
Right, bye.
I just want to take a second to interrupt this episode. I hope you guys are learning stuff so far, but I do want to give you an opportunity. Now, I'm going to be trading every single morning. I'm going to be live. You're going to be able to sit and watch me enter and exit positions, executing the system that you're learning now. If that is of interest, I'll put a link in the description below.
Welcome to Lesson 4. This is part 1 of a 4-part series on market psychology. In this lesson, we talk about personal experiences with Chris's analysis and the most important market psychology skills that you need to have. Welcome back to the next segment. I hope you guys are enjoying the lesson so far. In this one, we're going to be talking about trading psychology with Chris. Thank you, Chris.
Hey, you guys. Today is a good day to talk about trading psychology for everybody who's watching. It's a Friday, so we've been through quite a week. We've had the crypto markets blow up, the market explode higher. And so we're all ready to talk about how important it is to keep your mental act together.
Exactly. I like
100%.
it. You want to dive into like one of the beginner mistakes? Like everyone say someone, opens a Robinhood account and deposits $500. And the first mistake that they would typically make.
People listen to everybody else but themselves. So maybe the first mistake is listening to somebody else's advice, like I like Apple stock or I like Nike or something like that. And I think if we look at things that we like, if you have an understanding of, say, for example, you follow Nike and you follow their sneaker line and you're a sneaker junkie, then maybe you trade Nike because you understand it better. Remember that you're competing against people that are so much smarter than all of us, and they have much more information than us, and it's impossible for us to know everything. So the only way that we stand a chance is first liking or really, really being absorbed by whatever product you choose to trade is. So I guess that means that you need the concentration and the curiosity and the desire.
Yeah.
Right. And so the first mistake would be not follow. I mean, it sounds so cliche, right? Not following your own intuition into regards to what you're curious about.
Sure. Okay.
And then, so, I mean, I know you got, what's your favorite thing that you trade? Doesn't everything have a different personality?
Yeah. I mean, the favorite stock I trade.
Yeah. What's your favorite?
This year, let's see. I've done well on, I traded DIA, the diamond, diamonds. And then that's tough because I don't day trade, I swing trade. So typically like I'm just trading very individual names and I won't trade them more than once throughout the year. Like this year, I've only traded the same name like a couple times. But again, I'm trading mid caps and then swinging those over a couple days. I'm very selective and patient. I think, trading psychology, a huge part of it is just being disciplined, sticking to your plan and your strategy, And that's something we want to talk about too, is the discipline it takes, and over time how you'll build up that discipline. It's not easy. It's not going to come overnight. It takes a lot of time. It takes a lot of losing money too, to really understand that.
If you're not in control of the way that you're thinking, then you're just going to be roadkill from the market, period. Can you imagine, right? Like, you're wrong and you don't have the discipline to get out.
Yeah.
Right? That's got to be the worst.
Yeah.
Right. But then, I mean, every other time in our lives, who's there to make us get out of losing trades? Like, there's nobody.
Yeah.
Right. So the idea is that we need the discipline. I guess what it would be is that it all stems, in a sense, from what used to happen on the trading floor, where we did everything by word of mouth, right? It's like you look across the ring and you trade with somebody and they would just see you nod and then they'd write it down on their pad. And then from that came the expression that your word is your bond, right? And I would suggest to everybody who's watching this that they start with that first maxim, is that you keep your word when you give it.
Yeah.
Okay, that would be a good way to practice self-discipline, is you keep your word. You never go back on your word. If you make a promise, you do that. And from there, you can learn the discipline to act when you're wrong in trading. Do you guys want to talk about how hard it is to admit you're wrong?
I think being able to admit you're wrong is a huge skill in trading. I mean, just from my personal stories, I remember when I first started trading, I would say put on a day trade. My kind of first time trading, I was really drawn to the S&P. It was, it was all over Twitter, YouTube, how to trade the S&P. It's kind of like the golden standard for a market. And I would be in a position and I would be, physically or emotionally attached to the money. And when the position went against me, I was like, okay, the position will come back. Or I'll say, okay, now I'll go down to the support level. And the position would ultimately, I'd, lose a good chunk of money, and then I'd feel bad at the end of the day. So it's like, being able to admit you're wrong is going to minimize your losses. And then once you realize you can admit you're wrong and then get back into a position, right? When the position starts to become actually favorable, okay, get back in. And who knows, maybe you'll be wrong again.
So what do you think the idea? Well, obviously, okay, so we're saying actually that the ability to admit we're wrong is one of the keys to remaining in business.
100%.
100%, right? So, but nobody likes to take a loss, right? So the idea is that if it's getting close to, how should we say this? Like, a losing position is like cancer, right? You want to get rid of it as fast as you can, right? If you get cancer, right, they're like, cut it out immediately, right? Like, go to the doctor. If you have skin cancer or something, they get it when it's small. And a loss in trading should be just like that, right? A small loss is like cancer. It's much easier to take out the small cancer when it's small. Yeah. It's much easier to get rid of a losing trade when it's small. Mm-hmm. And then it leads to what you're talking about, being flexible in regards to getting back in.
Yeah, you can get a better entry.
Yeah. And so maybe being active in that respect of taking losses when they're small, and then being active and forcing yourself to get back in, the cliche of getting back up and swinging again at the ball, is a more healthy way to go about it, rather than trying to defend a losing position emotionally and financially, right?
Mm-hmm. Yeah. So I want to bring this up because I heard this quote. I think I've read it on Twitter. Or no, I read it in the book, The Market Wizards. It is kind of confusing, so I'll repeat it and kind of break it down, but I'm really interested to hear how you dissect it, because it plays into like keeping your losses small and getting out when you're like knowing you're wrong quick. Mm-hmm. And the quote is or it's not a quote, but it's actually a fact. It was a statistical, psychological study done on people, and it's, would you rather have a lottery to the upside or a sure win? So, but the lottery to the upside, you can take a small loss, right? So it could either be a small loss or a big win, or you could just have a sure profit. Okay, right? So that's one side. And then there's the other side. Would you rather have a lottery to the downside, but the opportunity of a small win, or a sure loss, right?
There's all sorts of asymmetric, they do studies on this, right? Yeah. All the gamblers and things like that. And people's first priorities are backwards, from what I remember in that regard.
So people would take a sure win over a sure loss. And they would take a gamble for a loss to go back to a win. Mm-hmm. Right? So it's like, I'm sure I didn't phrase it the best I could, but it's knowing that, like, take your small losses. Like, there's nothing wrong with taking a small loss. It's just psychologically, it's hard. We have to train ourselves to be okay with that, knowing it's part of the game and we can get back in.
I think people need to be able to hear that a small loss repeatedly over time doesn't make you a bad trader or doesn't make you a bad person. So we need to disconnect the idea that the trade didn't go our way. Okay. So what's the logic behind that? How do you let your ego unhook from a losing trade? And the understanding that works best that we've all come up with from the years on the exchange was, look, there's so many things happening outside our control, controlling prices that we can't see all around the world in different time zones at this present moment. And if something happened that we had no control over, couldn't see, that changes prices, there's no reason for you to have to defend your idea that this was going to work out the way you thought.
Yeah, I like that. I really like that. Another way too that I found helped me was realizing that losses are part of the game, and the best traders in the world lose. So what makes you think? What makes you think that you're not going to lose, right?
Right. Who gave you the sheriff's badge?
Yeah,
like
so it's
your
like,
God? Like no.
Exactly. So the fact, like, knowing that losers are a part of it is huge. Like once you realize, like, okay, losing like is part of a game. Like, are you going to run a business that has zero expenses? No. Like our losses are our expenses as traders, right? So being able to
think about we show up and we take losses.
Knowing it's part of the job, like knowing that losses are part of the job, and if you have a system and you're consistent and you stick to your plan, you're going to make money in the long run. Once you realize and you're completely okay with taking a loss, you're completely okay with seeing that red number on your screen, then it's like, okay, I know it's part of the process. But you have to detach yourself from saying a loss is a bad thing. A loss isn't a bad thing. It's just part of the game. And that's all it is.
Yeah, it's part of the requirements of staying in business. So interestingly enough, let's unpack that a little bit. Like, okay, if losses are part of the game, then obviously we want to minimize losses as much as we can. That means we need to be really discerning about where we start the trading process, right? Because a loss is, if you think about what started the process that created the loss, was that we made a mistake in regards to the first piece of the initiation of the trade.
This is part 2 of the 4-part series, and in this lesson we go over the entire process of a trade. From the planning, initiation, dealing with the trade psychologically, and moving forward after you've closed the position.
Right?
Yeah.
So if we're super discerning, if we curate our initiations of the trades, in other words, as you say, you have a system, but the whole system is predicated on the initiation of the trade. Yeah. Like, where do you get in? Because as soon as you get in the trade, you're managing the trade. Anything can happen. You don't know. Yeah. Reality is running the show.
Yeah.
Right. So the whole beginning thing is like, okay, I'm going to be super, super, super particular and careful and curated and discerning about the initiations of my trades.
Yeah.
Cause and effect is a valid function. We need to we need to create the cause to create a positive effect. Yeah. Means that the first thing we do is the initiation of the trade.
Yeah. I was thinking we should talk about kind of, having a plan in place. I think when you enter a trade and you have no plan, you don't know when you're going to be wrong, where you'll be wrong, how much you'll be down, when you're going to take profit, how much you'll make. You're just, flying by the seat of your pants. And it's not just from like a standpoint of having like a system where, your numbers and, you're going to stay, in the green, but it's from a psychological standpoint. It prevents you from trading with emotion, because before you enter the trade, you already know your max upside, your max downside. And then it's, okay, I put the trade on, now I can sit back. I've got my plan and I'm not going to make any emotional decisions. I think that was the biggest thing for me.
Yeah, but it doesn't work that. I mean, everyone's like, oh yeah, trade plan, right? Everything. It's just like a machine, right? Yeah. And then all of a sudden you get into it and you're just like
yeah. And your mind starts.
How are you going to, Pete Stottlemyre, Creator Market Profile, made 70 million trading brains for anybody who's watching, was like, you evaluate the trade when you're in it as though there may be more to this. And then remember, we're talking about like, we got to get past the whole, oh, that tick's good for me. Oh, that price moves bad for me, right? It's not, the price is moving. You have a position, but how it affects you should not affect your interpretation of the price action in regards. It shouldn't be in regards to you. It should be in regards to the whole marketplace.
Yeah. Okay.
right? It's like that. You have an inner cheerleader that's like, oh, it's going my way. Like Paul Hornblower would always say, I'm like, why didn't you cover at the lows? He had a huge short position. He'd be up lots of money. And I go, why didn't you cover at the lows? It was so obvious. Prudently, you should have a big win. You take it.
Yeah.
And he said, I was having a party in my own head.
Interesting.
Isn't that interesting?
Yeah.
Right? Like, so that you see that inner cheerleader right there, right? Like you're having a party or you're despondent when you're down all this money on a bad trade.
Yeah.
Right. And so that's natural and it's normal. And the market thrives on putting people in those situations.
Yeah.
So if you're going to get involved in the trading game, you have to understand that the market it's like the Marine Corps drill sergeant for your emotions.
Yeah, I like that. And obviously, like when you enter a trade, like your risk to reward is constantly changing, and you don't know what's going to happen. I think, how does someone, I guess the biggest thing is just detaching yourself from the monetary value and really being able to actually focus on the
you
trade.
just said something really brilliant. You said, how does someone, and then you didn't finish the sentence, and I'll finish that sentence for you. How does someone deal with the fork in the road when every moment that we spend trading, you're looking forward, like what's going to happen?
Yeah.
And that's extremely confusing. And imagine, to everybody out there are people who play softball on Saturdays at 11 o'clock. And every Saturday at 11 o'clock, they do things at a specific time. And skiers and surfers and people who exist outside in sports like that do things when the snow falls, when the surf comes up. Traders do things, they make the trade. These kind of people do things when the time is right. So there's a specific type of person who does things at a particular time, and then there's types of people who do things when the time is right. And so you need to make sure that if you're a person who does things at a particular time, you play softball every Saturday at 11 o'clock, that you need to step into this surfer skier mindset of going skiing when it snows, making the trade when it's right, riding waves when the surf is up, not when the ocean is flat, knowing when the time is right. And so that leads you to the discussion of you were always saying, like, where is the market going? What is going to happen? I don't know what's going to happen. And so that confusing, and essentially that's the way we live our life. Like, you have to come to terms with the fact that it's a confusing situation all the time. So at that fork in the road, how do you deal with, as you said, how do you deal with the fork in the road at confusion? And you either choose curiosity or you choose anxiety, right? Like, if you're flipping out that you don't know, you're flipping out like, God, I can't deal with the fact that I don't know, right? At that place, you got to move towards curiosity and say, hey, I get that I don't know, but I'm going to learn something new.
Yeah. I like that. Yeah.
Yep. So two things. One is, there are people who do things at a specific time, and there are people who do things when the time is right. Okay. As traders, we do things when the time is right. You can't force a trade, right? We do things when the time is right. And then we understand that we're going to be facing a confusing situation all the time. It's the name of the tune. If it wasn't confusing, it wouldn't be a market. And therefore, you got to choose curiosity over anxiety. Right? So you could always put a little Post-it note on the bottom of your screen, or make it your mantra, choose curiosity, right? You're going to be curious. Hey, I'm going to learn something new. That allows you to zoom out, because anxiety is you're just, as you know, right? Anxiety is not something that is flexible or is conducive to thinking in a broad spectrum, which of mental flexibility, as you guys were talking about.
Yeah. I mean, I'm thinking of like some of the worst trades I've taken and trying to reflect on those, to identify, where I was wrong, not just like with how the trade went, but my mindset. And like, I noticed that, like, if I put on a trade and I'm like sitting there like nervous, like, oh my God, like I'm what's going to happen? Like, that is the worst state to be in.
Yeah.
So what can, traders watching this do to, choose curiosity
right? Write a post-it note, or I mean, I used to write it on the top of my trading cards. Breathe. Like you hold your breath, you know, and your breath is strictly a mental function.
Yeah.
Right? It's not like if you're holding your breath, you're nervous.
Yeah, exactly.
Okay. Period. Okay. If you're deer in the headlights, like you're saying, right? Like you got a position on, you're like deer in the headlights. You're like, you don't want to be that person. Right. Yeah. I was reading a research paper today. I just found one today that said walking actually increases creativity. And I was like, well, okay, boys, if you're a deer in the headlights, go for a walk around the room.
Yeah.
And try and go to the bathroom, something like that. Just shake off you need a flexible mindset.
Yeah.
Which you guys are great at. You got that, right? You're like, hey, the first thing I learned was small loss, flexible, change it up, move around, be active, right? And essentially it's another stupid cliche, not a stupid, but it's a cliche. Like, look, you're being active. You're participating in life. I sound like an ad, right? The idea is, and this guy, Dave Stone, he was a huge trader in gold and crude oil, huge, massive trader. And I asked him, what do you do when you're having a cold streak? And for him, a cold streak was like hundreds of thousands every day. And he was like, I trade small and more actively.
Okay.
Which is exactly what you guys were talking about earlier about taking losses. Like, hey, I'm going to be active.
Yeah, I have a point to make. It's like, if you know, right? If right now you should know that losing is part of the game. So why would you willingly put on a lot of risk when you know that there's the possibility of losing? So knowing that, you have to be mindful of what type of loss you're willing to take and then size accordingly. Because if I know I'm going to lose, I would say, okay, how would I feel if I lost this money? So I'm not going to, put half of my account on a position. I'm going to put it, when I trade, especially when I day trade, I put on like an amount that I know I'm comfortable losing. Because since I know losing is part of the game, I can easily just get right back in there, because the way you're actually going to lose is by not getting back in the game. Because it's a statistics thing, right? You're going to win a certain amount, but you're also going to lose a certain amount. And you might go on a losing streak. But when you stop trading after losing, you're down and there's no way to recover. So you have to keep trading and stay in the game, because ultimately staying in the game is more important than 10xing your account. Because if you keep your account and you don't blow up, then you still have that opportunity. But if you lose all your money, then there's no opportunity left.
Right. How can you develop a skill if you blow out? And essentially what you're doing is, because the market's evolving, you're evolving. And so your skill is getting better. I've seen it in both of you. I've just in the recent couple months, your skills have gotten way better. And so being active and small, right, creates a positive cash flow. Yeah. And that's emotionally very healthy.
Oh my gosh.
This is part 3 of the 4-part series, where in this lesson we talk about the mentality you need to become successful and the marathon that is becoming a successful trader. We talk about the mental game that you need to have with yourself, from lifestyle to your conscious mind. How do you deal with those, people who, want to start trading or they start and they treat it as a lottery ticket and they're trying to make big gains, or they're like, oh, it's $1,000. Like, it's not going to make a difference if I lose it, but if I made 100,000, then that could, help me out so much. Like, what do you say to someone who would do that?
People generally think they know best, right? What do they have those polls of drivers? 70% of people think they're better than average drivers, right? So it's very rare that you're going to find somebody who's curious without having experienced some degree of pain, right? Because if they start out, generally people start out, they're like, I'm smarter than most people, and I know what I know.
Especially traders. Right. Like, the people who are trying to get into trading are the people who think that they're smarter.
Right, right. Like, I got this, right?
Honestly, I bet the trading statistic asking, do you think you're smarter than the average person, is probably like 80%, 90%, because traders are cocky.
Yeah, they gotta be, right? And in a world where 80% of the people lose everything, 80% of traders lose everything, which is great. That's what we want. Mm-hmm. You want to be in a business where nobody makes money, because that means the upside's unlimited. It hasn't been figured out. That hasn't been figured out yet.
Mm-hmm. Yeah.
Right. So everybody watching, hey, you're in a game. You can, if you get it, you can never have another job, boss, paycheck. You make your own decisions and you trade for a living, period. Realize that probably 8 out of 10 trades you make have a good potential of being wrong, because 8 out of 10 traders lose everything.
Mm-hmm.
So I would say, what would you guys say to a new trader? Try it. I'll meet you here in a year. How's that?
Yeah,
Yeah, it's cool.
And I think just don't start out thinking that the stock market's a lottery ticket. Just don't set expectations. I think a lot of people set very like false expectations when they start out.
I remember my first time trading. It's like, I'd make a 20% or something on an option contract. I'd a few 100% lucky winners on option contracts. And I'm gonna be like, if I just make 100% like 5 more times, I'll be a millionaire.
Yeah,
Like,
isn't it great? I mean, it's great. You have to admit, right? It's the greatest game.
oh my gosh.
I mean, it's the greatest game, and the people are wicked smart, and they're not your friends. And
they're friends after or before.
yeah, right. We're all friends later, but and so if they're not, and you only hear from the winners, right? The losers go away and they don't say anything. So and everybody goes to work expecting to win. And so, so it's kind of skewed. You have a good day. You're like, of course I had a good day. I expected to, right? And then if you come and you have a bad day and you're like, oh, that sucked. So you need to keep sort of an emotional barometer, knowing that A, you're doing this on your own. B, that it's confusing and highly skewed towards failure. And that, that the winners you accept as normal and the losers have a bigger emotional impact.
Yeah.
So, right. So it's important that you don't take it out on your friends. It's not their fault.
Yeah. And like I was going to say to that, like it's important how you treat, your winners and your losers, and that you're treating them consistently. Because if you have a great day, you make $10,000, $15,000 or $500 in a day, and that's a big day to you.
Or $50.
Right. $50. Right. Yeah. We want people to make $50 a day, every day.
Well, consistency. But I'm saying if someone has a giant winning day and then they're like, oh, I'm going to go out, buy dinner for my friends, throw a party, go out, drink, whatever. Then it's like, well, what are you going to do when you lose 10,000 on a day? Are you going to sit around and be depressed? So like, you don't want to ride that emotional roller coaster. You have to be consistent in how you treat yourself based off of your performance.
I mean, there's two schools of thought, right? You can celebrate big wins, and people have always done that. And I have friends who celebrate big losses as well. There is a very destabilizing effect with big wins. I have noticed that myself.
A big win is almost more detrimental to someone's game than a big loss.
Yeah. It is.
Like it could F with your. Can we swear on this? I don't even know.
I mean,
it can fuck with your head. Because all of a sudden you think you're this big guy and you could put on too much risk and lose a lot.
Or win streaks when you get on like a little run and then you start sizing heavier and heavier and heavier.
Yeah.
Which is good. Like when you're on a winning streak, you should be sizing heavier. I mean, I've heard it from all the top traders in the world. When you're doing well, size accordingly. But when you start doing badly, you start losing, minimize that size. Like you said, who was that? Hornblower? Who was that?
Hornblower. Yeah.
Yeah. When he starts trading bad, he goes to small size and trades often. And when he's winning, his size increases.
Yeah. That's Dave Stone. Hornblower has a party in his head when he's winning. Huge.
Okay, yeah.
I've seen people who cancel their vacations when they're on a winning streak.
Really? Wow.
Right. Because you can't. It's the best feeling in the world.
Mm-hmm.
Yeah.
I mean, going like, I'm not going to lie, I still fall subject to it. Like all the good day trading, I'll be super excited to go into the office tomorrow and trade, and then sometimes I'll have a bad day trading and like, I won't be as motivated.
Right. It's a dread feeling. You wake up in the morning and it's a dread feeling.
Yeah. It's almost like you're not excited. And that's frankly something I'm working on as a trader, it's waking up with that neutral attitude, not being based off how I performed yesterday.
And even these conversations are helping so many people with just because they are going to go through the exact same thing.
Yeah.
Mm-hmm.
And so what are you working on now?
Personally, what I just talked about, knowing that it's, I realize and I can like logically say everyone loses. Everyone has red days. I just have to, but also, people have green days. So I got to be able to neutralize how I'm feeling when the market opens and saying, okay, not basing my mental attitude off of how I performed yesterday. And I've been getting better at it. I'm pretty neutral, but it's definitely, I feel less motivated in the morning when I had a red day.
Yeah, of course. Someone said to me once, they said, if you're a new business and you go to the bank's not going to loan you money. But if you have a track record and the track record goes for a couple of years and you go to the bank and you ask to borrow money, they'll loan you money. And that they use that as an analogy metaphor for the understanding that as traders, as you get more experience, in other words, as you get a positive track record, you can withstand a losing day without it really affecting you as emotionally as it
knowing
has.
that losses are involved, right?
Yeah.
It's being aware.
Right. Isn't that interesting?
Yeah.
Like if we treat our own trading as like our own business and we want to establish an emotional track record of positivity, we can then sustain a negative financial and emotional event without causing us to crash the system.
Mm-hmm.
Yeah. And I think it's important to not let your day, whether it was a great day or a bad day, reflect your life like outside of trading, like your family. Like if you have a bad day, you lose a ton of money, then you go home and you're like, whatever, you're getting frustrated at your siblings or your wife or girlfriend or whatever. Like that's bad. Like, but then on the other hand, if you have a great day and you get home and you're all happy, I think really just keeping like your emotions to yourself, and keeping it in the office maybe. And
there were guys it was well known, on 5,000 guys were on the trading floor, and it was well known among them to whether you had made or lost whatever amount of money, to cut it in half when you went home and told people how your day, because everybody wants to know how was your day.
It's true.
Right? Because you're not making a salary. They're just curious, like, did he make or did he lose today?
Yeah.
And so the common knowledge on the floor, and it's not, it was just what I learned, was just to always shave that number down in half, which is to your point, right? Don't kick the dog. Don't take it out on your mother, your wife, your girlfriend, your best friend, right? Because the idea is that we're trying to, you cannot not feel.
Mm-hmm. Yeah, we're human,
Yeah, right?
Yeah.
Like, I took you guys to a yoga class.
You take.
I missed out on that.
Next time. You'll join us next time. I went to a yoga class. That was fun.
Yeah. And so ride your bike, right? To everybody out there who's had a day, the physical aspect of stress reduction is probably the healthiest.
Yeah. Yeah. Working out every day.
Yeah. Working out is huge. For me. Mark and I both are avid gym goers.
I worked out this morning. I always come in with like a clear mind, and I just feel like my body, I just feel like I'm in like a good mental state, like a good place.
Right? Like get up, make your bed, clean your apartment.
Yeah.
Right? Make sure everything is in its place. Mm-hmm. The monks, when I was working with the monks for many years, would always say, dress up special, as though you're going to, like, your job is something special.
I like that. Yeah,
so that plays into what we do pretty well. We wear suits to our own private office. No one's making show up. We could show up with PJs with coffee and peanut butter stains on, and no one would know. Tell us what to do. But we all willingly wear suits. So that's actually really funny you say that.
Yeah, they even said things like step with your left foot into the building first.
Really?
Why?
Why is that?
Just to remind you that it was special, right? Like you're going into a special place, and like you're getting dressed up, wearing a tie. And so even to the point of like you cross the threshold into the building with your left foot forward.
Okay.
Interesting. Okay, that's the Tibetan monks, right?
Yeah,
they were like, I was like, okay, I'm down with that.
I love the making your bed in the morning. I always make my bed in the morning. I read this book called Habits, and it talked about how when you do one productive thing, it's easier to do another productive thing. But if you start, if you wake up at 11, it's going to be a lot harder to be productive the whole day. But if you wake up early and you make your bed, you go to the gym, when you step in that office, your head's going to be clear and you're going to be a lot more focused, right? So that kind of plays into pre-market, and pre-market is,
I just want to take a second to interrupt this episode. I hope you guys are learning stuff so far, but I do want to give you an opportunity. Now, I'm going to be trading every single morning. I'm going to be live. You're going to be able to sit and watch me enter and exit positions, executing the system that you're learning now. If that is of interest, I'll put a link in the description below.
This is the final part of the market psychology section, where we come to a conclusion. We go over pre-market and how to become the most effective every day, as well as the habits that you need to form. Chris also talks about the positive and negative effects transitional coping skills may or may not have on you.
How big of a role does pre-market play in your trading?
Me specifically?
Yeah.
Yeah, every morning I'll go through the market. Obviously I used to, in California, I'd have to get up super early. Now I get up at 8 o'clock, and I'll spend a good 45 minutes going over a bunch of tickers and trying to identify 3 to 4 stocks that I'm going to be looking at on the day to give me some direction. And, I'll have the stocks that I'm watching closely, that I'm ready to trade, that I have like somewhat of a plan, laid out in front of me. And then it's just waiting for the opportunity, which may come that day or it might come later in the week.
Yep.
Excellent. It's, before someone gets a job, they interview them. In a sense, that's what you're doing there, right? You're interviewing the stock or the participants in that stock. And does its behavior make sense, or does it fit the plan?
Yeah.
Or, right, do we have an edge? I mean, there's so many cliches, right? If you're not the smartest person at the poker table, if you don't know who the mark is at the poker table, it's you. Same thing if you're trading without your particular setup or your edge or your understanding of where you fit the foreground versus the background, or why, right? Why it doesn't matter why the price is moving. It matters why you're doing what you're doing.
Mm-hmm.
Which is interesting. But pre-market is especially good. Make sure that you're not over caffeinated, right? That you're breathing, that you got a good night's sleep, that you're not fighting with somebody.
Yeah.
Because that will bleed into the markets.
Yeah, exactly.
Curious.
Pre-market too, right? You need to not have a bias. Like I was thinking about that earlier. I was like, make sure that you show up knowing that anything could happen.
Yeah, I think honestly, like even writing that down on a sticky note, like when you anything can happen. That reminder for me every day would be good.
Yeah, like no bias. Anything. I'm good with whatever happens.
Yeah, I like that. Okay.
Right? Mm-hmm. Or how about this? Frame it in the positive. Let the market tell you.
Yep.
Yeah.
Because it will. If you're listening, it'll tell you.
Yeah.
Isn't that cool?
Yeah, it is. We were talking about too, knowing when, like, if you're playing a direction and it shifts, being all right with that change and accepting it and being able to, turn around.
Being able to being able to switch your conviction on a trade is like when you are in a trade and let's say you're long and like this, you go short, you go net long to net short in a span of 2 seconds. That's when you know that you have made significant progress in your psychological part of trading.
Right. It's almost like you get over yourself.
Yeah. You admit you're wrong and change your mind.
Right. Like I'm still me and I can be wrong and I'm going to still be in step with the present moment is as alive as a human being as you'll ever get.
Yeah. I agree.
Yeah, I like it.
I was trading did you ever introduce you to Prescott?
That's coming.
Yeah, that's coming. He's we were trading together live
last night.
Yeah, we were trading together live. That was after CPI came out, so that crazy day. We're both sitting there. We're like, we have no conviction of the market. Whatever happens. We're curious. This could go all the way back down to its lows, or it could just rocket. So we came in with no conviction, and I was trading with him, and we were both long, and the market started going down. I just got out. We both got out at the same time, and then all of a sudden the market started taking, and then I was like, oh shoot, like should have switched, and he switched like that.
Wow.
He went from net long to net short like that, and he made like $10,000. Like,
isn't that great?
Like,
that's a very skilled.
I was like, wow,
person.
Okay, like that's super impressive. You just did. I went like market psychology is half the battle, and because
probably more.
Seriously,
because it's so hard to admit you're wrong.
Yeah.
And then completely switched your opinion like that, because people were trained to stand our ground and defend our opinions and be confident in what we're saying. But in trading, it's like you have to be able to not only say you're wrong, but actually agree with the other person. And that's hard. That's so hard. And then to do that with your money in a split second, like it's it makes sense like logically, but when you're actually there doing it, it's not easy.
Mm-hmm. So we call that transitional coping skills.
Yeah.
And so people who have checkboxed their way through life, good schools, Ivy League education, full, Ivy MBA and things like that, or MIT, generally have been told, this is the way things work, right? And so the markets, they don't necessarily respect the Ivy League mentality. And so the idea is that people with a non-traditional background, such as ski racers who crash and cartwheel 7 times and dust themselves off, they're very quick to say, I'm not going to do that again.
Yeah.
Right. And so that sense of flexibility is why they had on Wall Street, there had been a demand for people with non-traditional backgrounds to teach trading, because there was no sort of drilled in response that this is I went to Harvard, I was told this is the way things work. Therefore, because Harvard's such an institution, I will continue to do things this way. But the markets don't respect that at all. The markets are nonsensical, and it's just a game of keep up. And so, as we could frame it as transitional coping skills. And so, was it Preston you said?
Yeah.
Excellent demonstration of that right there.
Yeah.
Excellent.
No, when he told me that, like, my respect for him as a trader, it definitely went up. I was like, wow, that was impressive. Just being able to switch your conviction like that in a split second, and then knifing a trade, and then making those it was really, I was frankly like, okay, that was, and that also plays into like networking, who you surround yourself by. If you surround yourself by great traders and you can learn from that, like that definitely played in my mind. I was like, wow, okay, that was impressive. Being able to switch, like, I need to be able to switch my conviction like that and have no attachment to whether I'm right or wrong.
Right. It's just get in the game now. And the mental and financial aspects of holding on to a losing position,
Yeah.
It's interesting. You can go to a party and get into a conversation with somebody, and you'll see them defend a losing position, whether it's in politics or something, and just have that in your brain, have that light bulb go off, and just be like, you can see people's confirmation bias or their Dunning-Kruger, right? That they're better than everybody. And you can see that these people have never traded their way out of a paper bag, right? So you start to see in other people's behavior the things that are causing them to lose on trades. Isn't it interesting to watch your own progression?
Yeah. Do you have any advice for, people who get stuck revenge trading? They take a huge loss, they're trying to make it back, and then put their whole account into a position and then blow their account. Revenge trading is what kills so many traders. And I have my basic opinion and, advice, but I think it'd be great to hear yours.
Yeah. What's your advice?
You just can't think about the last trade. And it's so, again, it's so cliche, and it's the hardest thing to do, to actually put into practice. But you have to start, whether it's the next day, the next trade, with a clean slate and just completely reset. It's from what I have done with my practice, it's just all mental. And, don't look at your last loss. Don't look at the stock you traded, whatever you can to keep that, whatever just happened out of your mind, and then take the next trade as if it's like a fresh trade, fresh day.
Yeah, that's hard to do.
Yeah,
obviously.
exactly.
It's so even 40 years into it, I still am pissed.
Yeah,
when I lose.
I still have.
And so here, let's frame it in the positive. You guys have always heard this, right? If the brain thinks in pictures, so that if I tell you what not to do, if I say don't think of a pink elephant, right? People think of a pink elephant, right? So the idea is that, let's say, what would be the positive thing to do? So if you're upset by a loss and you're revenge trading, I would say the positive thing to do would be curate the next trade to make sure it's a winner, right? Be really, really discerning about that first initiation after that first loss.
Yeah.
And just wait for the perfect setup.
Okay.
Because that's more rewarding, right? A winner after getting smoked is important.
100%.
Okay.
I agree. And honestly, I think we're kind of rearing up on our time here, Chris. I think you got to balance that in 5 minutes. So that was an awesome.
Yeah,
Yeah, definitely so much to talk about. This was
right. That was brilliant, talking about, revenge trading.
Yeah. Yeah.
That's a ball buster. I'm
so
with you
hard.
1,000,000,000,000,000%.
Mm-hmm. Yeah, realizing all the aspects of trading we have to improve on as traders together. We're all still working. Chris, you've been trading the markets for over 40 years. Are you still working on your trading? Are you still improving? We're all, we're all in this together. So
yeah, I'm curating my entries. That's all I'm working on, is I'm curating and being discerning about my initiations, because the rest of everything unfolds right from there. So if you just are wait for the perfect, where you're comfortable, where you have enough thick skin to be like, I really think I got this one.
Yeah.
Yeah. Well,
Because the marginal ones, you burn emotional capital in a situation that's, you're burning emotional capital on a less than perfect entry.
Wait, emotional capital, can you just like explain what that means? Like generally.
Yeah, like emotional capital, like you get in a fight with your girlfriend, you feel horrible.
Okay.
Right? You can't replace emotional capital, or you lose a lot of money, right? You feel horrible about yourself. And you can't replace that by just walking down the street and like a vitamin D from the sun, right? Think about the types, right? You have regular financial capital, you have emotional capital, you have psychological capital. I guess it's the same thing, right? And then you have your physical capital. You don't want to crash your bike. So emotional capital is something that you have to guard it. So you don't rogue trade. You don't rogue trade with your emotional capital.
yeah.
All right.
Good.
That's a great, tip to end on.
Oh.
Yeah.
All right. Well.
All right. Yeah. All right. I'm going to the mat. I'll see you guys later.
Great.
Safe travels. Keep in touch.
Yeah.
All right,
100%. We will.
All right, we hope you guys enjoyed this segment. Again, we're going to continue progressing along together. Jack and I, Chris, and we're going to be mixing in Steve Hawkins as well. So
Yeah. I think we're pretty much, I'd say halfway.
Yeah, we're
halfway-
about halfway through.
Yes, this is at this first semester done with. We're going on winter break, and then we're going to start really getting into it in terms of market psychology as well as advanced market structure. Working on market profile with Steve and Chris. So I'm really excited. Really, now we're this is starting to get serious, and this is the stuff that's going to level up your trading. So I'm excited.
All right, on to the next lesson.
See you guys in the next one. Peace.
Bye.